Well, good morning, everyone. I see that it's 9 o'clock or shortly thereafter, so I'll call to order the APERS quarterly board meeting, and I recognize the presence of a quorum. And the news media have been notified in accordance with Arkansas Freedom of Information Act. And really, before we get started, Philip, we have iPads now for I think a real benefit to the board. So would you maybe go through it a little bit and tell us about them?
Yeah, so the entire board packet's been loaded on these devices. So as soon as you open up the cover, you should see that on the screen. Pretty easy to navigate. There's just bookmarks along the right-hand side that you can use to sort of scroll between the different sections. Just using a single finger will allow you to scroll through the contents of the packet. For whatever reason, you get lost or come off of this document and you're back at this screen, you should be able to click on this red icon up here. Up in the corner, there's really almost nothing on the screen except for this one red icon, and that'll get you back into the board packet. If you got any problems with it, wave at me and we'll see if we can get you hooked back up with it.
Sure. Any questions? Thank you very much. Also, we have a new board member, Judge Barry Oring, who's our Benton County judge. And I understand that you were here, Judge, in October. And I'm sorry I wasn't able to attend that meeting, but we're certainly glad to have you with us this morning. Very well. Our first action item is approval of the minutes for August the 17th and October the 25th, 2022. Do I have a motion to approve those minutes?
I move that we approve the minutes.
I have a motion to approve the minutes. Do I have a second?
I'll second.
I have a motion and a second from Auditor Lee. All in favor of approval of the minutes, say aye.
Aye.
Any opposed? The motion carries. The next section of our agenda is investments, and we have a quarterly report for the period ending September 30th, 2022 from Breon Weymouth and John Jackson of Callan and Carlos Ramos of our staff. Yeah. I know. We just did.
Good morning, everyone. We are going to start with our executive summary. So this is in your on your iPad, and then if you have the big book, which it doesn't look like you all have, but it looks like it's only on the iPad. So we're not going to get to the book yet. It looks like this on page 10. So I'm going to turn it over to Carlos. He's going to do our market overview, and then I'm going to talk about the portfolio.
So if you flip the calendar report, you're looking for a page with a big graph as we try to fix the screen.
Page 11.
It would be page 11 and then page 1 on the calendar, the bottom right corner. So since the October 17th board meeting, if you recall a little, just to bring you up to date, a little reminder, for June fiscal year, the June 30 for APERS was down 10.5%. And at the time, the Ukrainian war, inflation fears, and fear of recession is what the topic of the time was. And that continued into the third quarter. So the first quarter of the new fiscal year. So I write the annual report, so I always keep notes for myself as to what happened and when. So when you look at this page, you know, Callan does a very good job of putting some bullet points at the bottom of this page. If you can see it on your iPad, hopefully. So some headlines, right? Energy.
Used about maybe what page we're on. Everybody's kind of searching. So on the iPad,
On the iPad,
It's page 11
Page
on
11.
the iPad,
go off the middle number.
Sure.
Should read page 11 on your iPad.
and it looks like this.
Okay,
Session one. Yeah, here. GDP drop. It's controlling the screen up there. Put it on.
Yeah, we're having technical difficulties over here.
It's totally normal.
technical difficulty. So I've got my. board. Oh, how did you do that? Yes. Hey, Judge, how are you doing?
Good morning.
On page 11, right?
I am.
I'm gonna hit the back button, it takes me totally out. So don't hit the back button.
Michael, that's.
Yeah, I
Oh,
know.
it's not showing up on the PDF.
I wanted to go back to something else and I hit that button.
You got all
That will take you out of.
Yeah.
Yeah. The exhibit's not showing the
Check it.
picture
This
on
picture is
the
not on this.
PDF.
Mine's up and going, but I haven't.
Later on in the agenda, so is the report at the end? Yeah. Where's the page?
I'm saying the graph isn't coming up on his.
Six. Oh, thank you.
All the other information's there.
Okay.
Yeah.
No lines.
You got the graph.
I think so.
Graph.
Have to hard copy. Just follow.
I got the graph. I got the graph. Finally, here we go. Okay, thank you, sir.
They're getting it.
But you did, I'm impressed. Okay, I was.
Yeah, here. I was looking for the big stuff here, see it on map. Look through there, I saw.
There you go.
Should help. Oh, so. Madam Chair, I don't think that's a good call, change the secretary. This is on you, man. Probably. Just for the record, we actually had some activity like this over teachers as well.
Yeah.
Only I got that, you gotta make my screen never dark.
Oh,
It teachers.
You get it?
Never.
Everybody good?
No. Good man. You on there, review the board.
yeah,
Okay, so if you have this on your iPad,
I was his bank commissioner.
you know, the bottom part of the screen, Callan has bullet points, but energy inflation was key and it continued in this quarter. Some headlines I wrote down, $100 oil, Saudi Arabia is pushing for it. China continued the zero COVID policy. So their economic outlook goes from bad to worse. August 26th, the Dow falls 1,000 points. Okay, Chairman Powell, some pain ahead as the Fed fights to bring down inflation. The next Monday, August 29th, Fed Minneapolis president said in an interview, he was happy to see the market reactions. Okay, so stock markets are key to monetary policy. August 30th, another Richmond Fed President Barkin, recession is a risk in getting inflation under control. So the Fed has clearly sent a message. They want inflation under control, even if they cause a recession. And finally, Chairman Powell said it himself. He abandons a soft landing goal as he seeks growth recession. So they're going to do whatever it takes to slow down inflation. So it didn't really work. US CPI in August was 8.3% for the year. September 13th, the Dow fell 1,200 points, 3.94%. Recession is the only solution to fight inflation. Then other headlines, Putin threatens nuclear war. On September 21st, for the third time, the Fed raised 75 basis points. On September 28th, 10-year Treasury hit above 4% for the first time since 2008. And then if that wasn't bad enough, on September 29th, the UK government felt some pressure as their new prime minister at the time came out with their economic plan. So the UK bonds and currency both got hit hard. So September historically is a very bad. September was no different. S&P alone down 9.2%. The bond market gave us no relief, down almost 4.5%. Fair Chairman Powell comes back out, will not be quiet. We have to get inflation behind us. The ECB, European Central Bank, hopped on board, raised their rates 75 basis points, and inflation continues to increase, not just here, but globally. So if you remember from the workshop, this page, the floating blue charts and green charts, remember, we went through how to read these things. This is a quick snapshot of how the markets performed. Floating blue charts is for the quarter of July, August, September, and then below it, floating green charts, September to September. Okay, so you see the bullet points to the left, but you'll notice at the bottom, as I said, the S&P lost 4.88%. So you see the floating blue chart, S&P 500 down 4.9. Third quarter in a row. First time since the global financial crisis in 2008. At the bottom of the page, you'll see the sectors that make up the S&P. You'll notice there's only two positive performers: consumer discretion and energy. So the energy sector, a lot of people think that's a little suspect as well, because the OPEC decision affected energy, and the government wanted to restock the Strategic Petroleum Reserve. So everything got hit in the S&P. So here's some numbers year to date for September. Natural gas, thanks to the Vladimir Putin's up 78%. But the rest of the markets, communication down 39%, information technology down 31%, consumer discretion down 29%. So September is a bad month. I'm going to set us up for the fall for October, though. It's looking good. Okay, so I'll give you some October.
September bad, October.
September bad, October. For October, the S&P was up 8.1%. So that's good. So it's recovered some. Small cap equities were up 11%. But we're seeing some signs, right? There's signs of the Fed. The market thinks the Fed may be slowing down on their rate hikes. So that's good. If we go to the next page, you'll see the international markets. International markets, no different than our markets, right? Central bank rate hikes and mounting inflation. I said earlier, China's economic situation went from bad to worse. Floating charts at the top, you'll see China alone down 22.5% for the quarter. For the year to year, September to September, the bottom gold chart, China down 35.4%. China is a major component of the emerging markets, and they're not doing very well right now. Okay. So that's no different.
Carlos, on China, they're still pretty much shut down is what I read. So when they decide that COVID's over, it's probably going to blow and go, don't you think?
I don't know what Callan thinks about that. I say maybe, and only because their most recent election, the Xi Jinping, Premier Xi, stacked his Congress in his favor.
Right.
So now it's an autocratic government. So it's still to be determined, right? Western investors have shied away from autocratic governments. So we have to wait and see.
Yeah.
I don't know if Callan has an opinion on whether China's going to take off.
One other comment with regard to China, from what I understand also that the Chinese are the population, their savings rate is significantly high right now because they're basically staying in and they're not going out purchasing things. So which is something we did also back at the early part of this. And then now the savings is being diminished because they're now out consuming, and the saving levels of average Americans has gone down significantly too.
And the difference I would say would be our central bank pumped $3.5 trillion into the economy.
Yeah.
Right, which we're starting to see the effects of the inflation now. So it took a year and a half, but it did hit the economy. John, anything to add on China?
Your point about consumption is well taken. We talk about whether the US is in an actual recession, given that, the first and second quarters were negative GDP, and that's the rule of thumb. And then the technical definition is a little more detailed than that Secretary Yellen would say, well, no, we're not technically in a recession. And the third quarter, we actually saw positive GDP, and it was largely based on a similar theme where our exports provided that external consumption, as opposed in the US where people were hiking their savings to a certain degree. So the same phenomena certainly, contributing. The backdrop on the China situation is, of course, the political one in terms of Taiwan, in terms of what does that drive? Does that drive investors to underweight the Chinese market, given the potential volatility in connection with that? Given that it's a third of the emerging market index, there's going to continue to be significant investment in China. And certainly the numbers that you see here are terrible, but it's been a long-term growth story. And the one thing that you can say about an autocracy is that when they turn on the spigot, certainly they can drive growth.
Yeah, there's been some news that they may be moving away from the zero COVID policy. So that could be a driver of growth. The challenge there is that they don't have a high vaccination rate. So there's no certainty that they're just going to open up again. So just a lot of uncertainty, which means a lot of volatility.
Thank you. Moving to fixed income. I think the only thing, it's no secret here, the Fed raised rates just twice in the quarter alone. So target's 3 to 3.25 right now. The market's now right now the target's 3.75 to 4. The market is pricing in 5 by early next year. So maybe just shy of 5. So the Fed's not done. I don't think the Fed's done. So just remember, on fixed income, it's a little different than equities, right? If it's a teeter-totter, as yields go up, price comes down. Okay, so as the Fed raises rates, our securities go up in interest, but they come down in price. And that's what we're feeling right now. When you see the Bloomberg aggregate down 4.5% in the floating line green chart, and then year to year down 14.5%, that pretty much tells the story of fixed income. So fixed income and equities felt some pain this quarter. But the good news is it looks like the markets are pricing in, maybe the Fed's done. So this was set up, Brianne and John, for the rest of the performance. Oh, can I give one more thing?
Yeah, absolutely.
So when Brianne goes through your numbers, your September 30 market valuation, 9.594 billion. Your October 31 valuation, 9.891 billion. And as of November 14th, unaudited, this one's on 10.149 billion. So the markets have come back a lot.
Thanks, Carlos.
Great. So I will move on to page 19 of the PDF and talk about the portfolio. So at the end of the quarter, the fund had just under 9.6 billion in assets. Your asset allocation, actual versus target, was pretty much in line. If you look at the chart in the middle of this page, the percent difference column, You can see that international equity was a little underweight, while you had some cash, which is held to pay benefits at, each month. And, overall, no concerns about the asset allocation, and we're pretty much in line with targets. Page 20 shows the change in market values over the quarter. Net cash flow makes up any benefit payments or cash that went out to pay benefits, any fees. And then what I'll point you to is to the bottom of this chart, we have the farmland category. So both the IFC Core Farmland Fund and the PGIM Agriculture Fund have been funded at this point. And so as they have investments, they will call more capital, and your full allocation will be realized. All right, so moving on to page 21, we show the high level asset class performance. On this slide, you can see over the 5-year period on the far right, positive performance from most of the asset classes. Domestic equity is the only one that wasn't outperforming, and they were just slightly behind the index. So overall, the asset classes are, the managers are working well with each other, and long-term performance looks strong. If we look at the total fund performance on page 22, over the last year, the total fund was down 14.3%, outperforming your target, which was down 14.6%. These floating bar charts, the blue dot is the total fund, the green triangle is the policy target, and the number next to it is the ranking. So for the last year, the fund ranked 61st, which means that it was below the median of peers. But over the longer term, the numbers, between 36 and 27, 27th over the last 10 years, and then over the last 20 years at the 42nd percentile. You'll notice as the time periods get longer, those gray boxes get smaller, which just means that the dispersion between other public funds becomes smaller. So over time, generally public funds are, returning fairly similar, and they're not seeing as much difference as you are over the last year. On the next page, on page 23, we get into the investment manager returns. I'm only going to really highlight kind of the high points, low points of managers here. Within domestic equity, pretty much everybody's performing in line with expectations. So, you can see that your growth managers tend to be doing very well because we've been through this long period of growth, where some of the value managers are either in line with the index, maybe trailing slightly. However, value is coming back into favor. And so we're starting to see some of that performance around. On page 24, there's a few more kind of points that I want to stress. So in your international equity portfolio, the first manager listed is Artisan Partners. They've been a really strong performer for the fund over the near term and long term. So they've been, in the ranking in the single digits over from the last year to the last 5 years. So really strong performer. Bailey Gifford is a manager that had just experienced some really tough performance earlier this year. So over the last year, you can see that they're down almost 40% versus the benchmark that was down 24.8%. They did gain some of that back over the last quarter. So we are continuing to keep an eye on them. Over the last 5 years, they're slightly behind their index, slightly behind the median of peers. So we're kind of paying a lot of attention to that manager because of that recent underperformance. Another bright spot, if we look at the small cap managers, Acadian has done really well for you since they were added to the portfolio. And then on the flip side, Franklin Templeton has had some struggles, mainly this year. in the portfolio and had a really tough quarter in the third quarter. Within the diversified strategies portfolio, each of the managers has a slightly different strategy, performing kind of in line with expectations. AQR has been a little bit challenged because their portfolio focuses on fixed income. So when interest rates have risen, that's hurt. But they also have some commodity exposure, which balances that out a little bit. And then Blackstone and Newton have both been additive to that portfolio.
I have a question.
Sure.
Madam Chair, thank you. So how, you say you're watching them, I mean, they're on the struggle bus? Like, when you watch them, what are you looking for? At what point do you say, okay?
Yeah, so Bailey Gifford is a very long tenured manager in this portfolio and one that we know really well. They have a strategy that looks at growth companies. And so when value came back into favor in the first quarter, they really struggled. Their companies were very much out of favor in the market. So basically their largest holdings were the worst performers in the market. What we would be concerned with is if they sold all of those companies and bought the companies that were just doing well, because that would mean they'd abandon their strategy. So we look for that they're maintaining their strategy. We look for any team departures if a portfolio manager were to leave or something like that. And we have them across the firm and in a number of other clients' portfolios. And we've also recommended them as a potential new manager to clients. So they're one that we have conviction in, but it's just because of this kind of out of proportion underperformance, it's just one that we've been meeting with a little bit more frequently.
Thank you, Madam Chair.
Do you communicate that to them?
Yes,
Your
well,
concern?
yeah, and they know. I mean, they are well aware of their performance. They've even been sending a few more communications on, performance kind of regularly intra-quarter to update us on what's going on and reiterate that they still feel conviction in the companies that they're holding and in their strategy. Okay, then I'll finish up on page 25 with the manager performance. The fixed income portfolio was down about 4.5% versus the target of negative 4.75. Double line was the strongest performer of your managers. We added them to the portfolio to be that diversifier to the Mackay Shields and PGIM portfolios. Mackay Shields was the biggest underperformer. They had a little bit shorter duration on their portfolio, which means that when rates go up, they had a longer duration. When rates go up, they're going to experience a lower return. So that longer duration posture hurt them. However, they still feel that that's kind of where they want to be. They think that rates are going to come back down eventually. So they haven't made any changes, but that has, hurt their performance over the last quarter and the last year. Longer term, they're still, outperforming over 5 years and their highest performer versus the other two fixed income managers. Core real estate and real estate in general has been the bright spot in the portfolio. We're continuing to see positive overall performance. The performance from real estate comes from income that's earned on the properties as well as appreciation. So that appreciation number is going down with kind of the recent economic outlook that we're seeing. So, we may expect to see some kind of lower returns going forward in real estate. And we've been talking about this for a while. We had really outsized industrial returns that propped up the index, but there's still some concerns within the office and retail sectors. Overall, your managers are performing well. The rankings are that you look at, particularly under core real estate, the Heitman Fund. This was one that we had some concerns about. Performance has been stronger for them. They have some self-storage that's kind of a niche sector that helps prop up their performance a little bit. And then the Invesco fund keeping up with the index. It's a little bit more conservative, but a good balance to that Heitman portfolio. We don't have any performance yet for the farmland investments as they're new to the portfolio. And overall, the fund was down 4.41% for the quarter. That outperformed your benchmark, which was down 4.9%. And over the last 5 years, up 5.3% versus your target of 4.7. You know, this last year has pulled down some of those longer term, the 3 and the 5 year numbers. But you know, as we saw earlier, 10, 20 years still above 7%. And then on page 26, we did have one organizational development at Mackay Shields. We have no concerns about this. It's just kind of some people moving around within the management of the company. And then their president, who had no input into your fixed income portfolio, did decide to leave the firm. Are there any other questions on the portfolio or performance? No? Ready to?
Yes. Go ahead.
Okay, so we're going to ask our colleague, John Perone's going to join us for this next section. We're going to talk about the asset allocation analysis. This starts on page 30 of your PDF. There are also green books that we passed out. We brought hard copies just in case.
All of us old folks.
Just in case.
You're not, you're right. I should.
So John is, he works in our capital markets group. They're responsible for all of the asset allocation work and asset liability work that we do, as well as any of those manager structures. When we've looked at, you know, had a deep dive into the international equity stuff, asset class, as well as domestic equity. So he conducted a study for us. And so we brought him with us to talk about his findings. So we're gonna start out. We included a private equity education, and you know, I thought we had a really great discussion at the trustee workshop. Really great questions from all of you about the asset class. I know that some of you weren't able to be there, so we thought we would just do a quick overview and also a refresher for anybody who maybe doesn't remember everything we talked about, and then we'll get into the follow-up from that workshop, which was to put together some portfolios and show you the risk and return of the total fund if you were to include private equity. And we did that at a couple of different weightings, so you can see kind of the impact that would have on the total fund. So I'm going to turn it over to John. He's going to review the private equity education.
Thank you, Brianne. Good morning, everyone.
Good morning.
I'm going to spend a few moments. The first 12 slides of the deck is going to cover the educational component. Then I'm going to turn it over to my colleague, John Perone, to talk about some of the modeling that we did. Again, a lot of this information is going to seem very similar to what you might for 25th, but we thought it'd be a good refresher. First 6 slides, I'm going to categorize as the definitional portion. You know, what is private equity, PE, why invest, the market, and then, you know, touch on maybe how it's performed relative to public equities. And then the subsequent 6 slides going to talk a little bit about implementation. How do you actually get invested? What does the program look like? And what are the alternatives? So with that, let's turn to page 2 in the hard copy. That'd be page 32 if you're following along on the iPad. So what is private equity? Public equities you're familiar with. They are securities that are registered on exchanges. They have subscribed and followed the SEC's regulation in terms of registration to kind of protect investors. So there's a disclosure requirements, et cetera. Private equity, in contrast, doesn't have the same protections by the SEC. It is unlisted and reserved for, I guess, whether you call it qualified or accredited investors. The idea is that it has less protections in place. The idea is that those investing in those securities will have a greater knowledge, sophistication, and be more aware of some of the risks associated with that. So again, the idea here is that, there are a number of differences that I'm going to highlight in the next few slides, but suffice to say, public securities traded on exchanges like the New York Stock Exchange, NASDAQ. Private equity, again, is partnerships orientation, where a general partner acquires an interest in a company and institutional investors take on the role as a limited partner with respect to that. So have you done anything like this before? Real estate. So there, you're going to see some similarities in terms of investing in real estate as you kind of think about the private equity portion. One is the funding mechanism in terms of calling that capital. When you want to buy invest in a manager in public securities, you develop a mandate, you say, okay, we are going to allocate X number of dollars to that manager. You execute the contract, you give them the money on an XY date. For private equity, you make a commitment for $1 mandate, and they call that capital as they see opportunities. So again, that funding mechanism, you make the commitment, I'm going to supply you with $200 million. I'm committing to that. They may call that capital over time. So think investment period, first 3, 4, 5 years of the life of that investment, they will be calling that time, that money. That's why we do an annual pacing study, much the way we do in real estate, in terms of saying, okay, how much have you committed this much capital? How much have they called? What is your current net asset value? So difference, nuance, but it's important. What's attractive about private equity? Well, describe it as an illiquidity premium, right? It's a longer term investment. You're thinking you commit the capital and the life of that investment can extend 10, 15 years. So how much do you earn? It's similar to the real estate market, where you may see intermittent appraisals of your property or home, but it isn't until you sell it that you know exactly how much money you made. And that's similar to private equity, that you have the investment in these partnerships that are germinating, and the underlying investments in private equity, they're at different places in the growth cycle. So depending on the type of partnership that you enter into. And you have, again, intermittent appraisals in terms of what that's worth, but it's not until the end of the day, which is extended some 10, 15 years, that you fully understand, was this a good investment overall? So again, valuation periods differ. You buy invest in a public equities manager, at the end of the quarter, based on the valuation of those securities, which are valued daily, exactly how much you made, how much that portfolio is worth. Private equity, again, is more appraisal based. You're evaluating partnerships. Again, they're less frequent, they're delayed. So when people look at it and they go, well, it's less volatile because we don't see it reacting to the market the same way. Well, that's true, but it's in part because of the delay in the valuation and the frequency. Volatility, when they say risk, they typically look at what is the volatility in the valuation. And if the market is very volatile on the public side, like it is now, you see the valuation going up and down. You can pull up the paper and you can see the Dow was up 600 points. The Dow was down 400 points. Kind of gives you a day-to-day metric in terms of what the volatility is. Private equity investments just don't behave that way. The frequency of valuation, it's much less sensitive to the day-to-day fluctuations. It's the periods of valuation, it's quarterly. And again, that information really just comes out 1 quarter or on a 2-quarter lag basis. So the data points aren't as frequent. Okay. So what's the primary appeal? With this illiquidity premium is what we describe it. You are giving up liquid assets or the ability to access the capital of your investments. But over the long term, you are generating a return premium over the more liquid investments. That's the attraction, at least if you invest appropriately. And there may be a concept, we call it vintage year diversification. The idea here, when you invest in private equity, it's not, I'm going to assign this much to a manager and that's where it stops. Similar in some respects to real estate, we see the private equity funds will come to market every 3-4 years. And the idea here is you're not investing in a single investment. It's more of a program that you have this vintage year investments that you are participating each year over time. And it's similar in concept, I guess, to dollar cost averaging. When you have your own 401ks or retail portfolios, the idea here is to be successful over time. You dollar average in, you don't take all your money out of the market and go all the way back in. High risk strategy. This is more along the lines of you make a commitment and over the life of the investment, you're putting the money to work. And every 3 to 4 years, you're re-upping with the new fund. So you're kind of, when you look at a 0.0, you'll see the ramp up phase. For the first 3-4 years, it's something called the J curve that you really don't see the return on your investment. It's not until the money is called, money's deployed, invested, that you start to see the returns on the latter end of the cycle. So again, that is the illiquidity premium. That is a drawback, right? If you need to access capital on a short-term basis, very difficult to do in a private equity. So again, why is that important? Well, your primary responsibility is to fund the benefits for your pensioners. If there is a point in time where you need to access capital, that is not a place that you can rent. Is it possible? Sure. But that would force you, there's a secondary market for private equity that you are at the bequest of the buyer. So in other words, you're not in an advantageous position. You may take a very steep discount in terms of what you get if you are forced to sell. So the idea here is illiquid, right? Now, we look at the liquidity profile of funds. Does it make sense? Relative to the last asset liability study that we saw, your requirements for making distributions to meet your benefit obligations did not approach the liquidity level that we would be concerned about investing in an illiquid asset. So that is, I guess that's the point. We work with some clients that, quite frankly, they had a program in place, and given their funded status and their pension requirements, that we suggested that they step back or reduce their exposure to this particular asset class just because of their liquidity profile. Not an issue for you all in our estimation. Okay. What else can I tell you?
Answer your question.
Yes.
So I recall from the what I'll call APERS school that I went to a few weeks ago.
Okay.
Plunging into this, that it seemed like this was getting into private equity was somewhat of a hot trend amongst pension plans. There was more money going in as of late. Does that trend change at all if we actually go into a real recessionary environment? Do these become less attractive to go into these private equity funds, or does that how does that change if we're actually in a recession?
Sure. Okay. If you turn to slide 5 or 35 and your iPads, I think this is the phenomenon you're highlighting. This is flows into private equity. And so the challenge is when a particular strategy is performing well, you're going to see investors are going to say, oh, this is attractive. Let's, load up on that. Certainly the returns premium. In an environment where you had, I think Carlos alluded to the fact that the Fed has increased rates 6 times this year. So what you were earning on a fixed income instrument has changed pretty dramatically looking at on a 10-year forward basis. And John's going to touch on this a little bit, but when you're trying to meet your actuarial assumed rate of return, it has been a very challenging environment going back to approach that return, given the low prospect. A lot of this is kind of a building block approach based on how much can I earn in fixed income, and then is there a premium over that for public equities, and then is there a premium over that for private equities. Whenever we see money flood into a strategy or an asset class like private equity, it does give us a sense of pause. And what is the rationale? Why is that? Because institutional investors needed to get that return. If you were to look 30 years ago, you might be able to meet your actuarial assumption with 80+% in fixed income. Well, now to get there, it's much more of a challenge. With the recent change in rate environment and the attractiveness in fixed income, relatively speaking, gives you a few more options. So first is, okay, it goes a long time. Is it a good time or a bad time to invest? We kind of look at it as it is a program. It is long-term investments. The challenge is that if you commit, say, $200 million, how much money is going to be called in the first year, and how much money is going to be called? You may commit it, but when will it be invested? And these private equity firms, their goal is they are launching a fund every 3-4 years. They don't want to invest in assets and perform poorly. So they're opportunistically identifying their investments. There's a big dispersion in private equity in terms of the outperformers and the underperformers. And that's why manager selection is critically important. The idea is that you want to go with a manager that has experience, has managed these assets, has demonstrated success in the past in their funds, and that they're judicious when they call capital. So certainly the flood of money going into private equity is a challenge. Does that mean that it's going to negate the premium that you earn over private equity or public equity? It may mitigate it, but our belief is that it's a long-term investment, that it's going to be called over time. It's not like you're investing the money, even if you were to decide to go into private equity, and then you select a manager next year. That money is going to be called over the next 5 years. So it's the version of dollar cost averaging in. And when we look, were periods where it underperformed, 2005 to 2007 were bad years for private equity. Okay, understood. But if you invest judiciously throughout the years, you are going to be just fine. I think there's a slide in here that looks at over the last 25 years. The last 5 years, you've seen a premium. If you turn to page 3 or 33 in your iPad, and you look over the last 5 years, private equity would have generated approximately a 21% return average versus 16% for public equity markets. If you go out 25 years, you're seeing about the same 500 basis point or 5% premium. So over long periods of time, yes, you would continue to expect that. But in any given 5-year period, could be difficult, could be great.
And one quick follow-up.
Yeah.
So if you commit $200 million and you're waiting for that to be drawn on by the manager retired, where does that $200 million sit? Is that just in cash or?
In equities.
Yeah.
So that's in
That's
equities
in
that can
public
be-
equities,
Okay,
yeah.
so that's in equities that can be sold then so it's
Right,
just committed.
yeah.
It's not just sitting there.
So you're still getting a similar kind of return expectation. Yeah.
Yeah.
And if we can switch back to 35, because your question about the recession, I mean, you can see here, 2007, 2008, where private equity fundraising was versus the following years when we hit the financial crisis, private equity fundraising went down. A lot of that had to do with plans kind of overloading their portfolio with private investments and then having a liquidity issue. So then they had to pare back their fundraising. So I think we're seeing a much less that phenomenon, but to a much lesser degree. So right now with equity valuations and fixed income going down together, clients who have private equity are going to have likely an overweight in that asset class because the valuations take a little bit of time to catch up. So they're likely to commit a little bit less in the coming year to keep that target allocation where it's supposed to be. Because now the other assets in the portfolio have gone down. So, I don't know that we're going to see that dip like what we saw in, 2009, 2010, but you may see a little bit less. So it's a combination, the growth being it's an asset class that's done well. Funds are reaching for return. And, those funds are still maintaining that, but they just need less money to work right now.
Okay, so just to jump back to the page 4. It kind of answers the question for 34 out of the iPad. What is the private equity market? Why is it attractive? Okay, so the idea here is that when you invest, this resides in the growth portion of the portfolio, as Brianne said. So when you're looking to fund it, you're taking it out of the growth portion, which is equities, as opposed to fixed income, right? So the idea here is that the deployment in private equity, while you're funding it, you're using a growth-oriented source of cash for that. And when you think about, okay, why would you embrace private equity? Because it provides a correlation benefit. It's not moving in lockstep with the public markets, but it is giving you a growth profile. So that is certainly attractive. The size of the private equity market, about 4.7 trillion. So while you have a sizable market, the idea here is the number of companies are much greater. So they're smaller in size, much smaller than anything that's out on the listed exchanges. Okay, so when you think of there are more private companies, but they're certainly smaller in size. So when you look at the public equity market, you're looking at about 47 trillion as opposed to 4.7 for private equity. And page 36, that segues to that, page 6 in the hard copy, shows the number of companies. So within the public companies, you've got 4,500 to 5,500. And when you look at the US private companies, you're looking at 300,000 to 500,000. So much smaller in terms of like ongoing businesses, much smaller cap. The smallest company that you would see in the Russell 2000, which is the small cap benchmark, is about 100 million. So that gives you some sense that certainly public companies are much larger in size. Turning to page 7 or 37 in the iPad. Who invests in private equity? So broadly accepted by the institutional marketplace. And we see that if you look at the pie chart in the bottom left, public pensions comprise about 86% of the investors in the institutional market. Sorry, 86% of the assets.
Of the dollars going to work because of the size of public funds. You're much larger than insurance companies and corporate pensions and nonprofits.
So insurance companies would fall into the public pension.
No,
They're separate breakouts.
unfortunately, the colors are very similar.
Oh, yeah.
But insurance companies, on an asset value, they're 4%, but if you look at the pie chart on the right, the number of investors, they make up about 7%. So it's much more balanced when you look at the number or the type of limited partnerships. You can see a better mix, but it's just when public pensions are all multi-billion dollars, all the state plans, and you think of a corporate pension is going to be a lot smaller than that, or a foundation, the dollar amounts are kind of dwarfed.
Interesting that corporate pensions, 20% of them are in it, but only 2% of the.
Yeah. Corporate pensions are becoming less and less from a dollar basis and just in existence in general. So.
Yeah, because the corporate pensions are, as you know, they're frozen or closed. So, but I think it underscores an important point, right? That you think about your all's time horizon as a public fund, it's perpetual,
Yeah.
right? So something like private equity is much more appropriate for you all than say a corporate plan that's going to be going out of business and shorter horizon than the actual investment you're going to do, right? Which again, private equity, you're tying up your money for probably 12, 15 years. It is a long-term commitment decision.
Page 8 is a summary. There's a lot of information here, but it's broken out in 4 categories. The characteristics of private equity, illiquidity, I think that we've touched on. Imperfect or infrequent valuations, we touched on that, and the difficulty in rebalancing just because you can't access the capital. So as Brianne alluded to, right about now, where real estate and private equity have performed strongly and fixed income markets haven't, most of them are above their target allocation. And you can't simply draw that down to put the cash into the underweight categories just because you don't have access to the capital. Return, higher dispersion between the successful firms and the unsuccessful ones. But overall, you have a illiquidity premium that's being earned by those. Cost, higher fees, certainly within the private equity arena versus public. And there's a complexity attached to the compensation. So while in private real estate, you have things like a base fee, and then you have maybe a carried interest, which basically is saying that if the fund earns something above an established threshold for private equity, let's call it 8%, they may take a portion of that, let's say 10%, as their revenue share. So again, in addition to their base compensation, they have this carried interest. And depending on how you implement the size of your commitment, the fees can vary. One of the vehicles that we're going to talk about is a fund of funds vehicle, which again, where you hire a manager and the manager oversees the program. So they invest in 29 to 30 partnerships, and you pay a fee, a layer fee for those folks. And that could be anywhere from, we've seen it go from 40 basis points to 1%. So again, it's complex. In terms of the time for staff to conduct the search, to do a redo every 3-4 years, to maintain that vintage year diversification certainly takes that time, and then legal approval of the documents. This goes without saying on page 9, page 39. This is just a schematic and talks about what are the underlying dynamics. You as an investor would be a limited partner, and then the general partner is, again, the person that's saying, I'm going to take your capital. They're the general partner in the partnership, and they actually, to a greater extent than the public markets, they have a greater level of influence in terms of changes that take place at the various firms that they work in. Page 10. This is a somewhat confusing chart, but accurate from the point of how do I know when I'm making money and how does it look on an interim basis? So when you see dark blue, this is capital calls. This is the fundraising period. So that you commit amount and then they call that capital. So they'll say you commit 200 million. And then in the first quarter or the first half year, they say, okay, we need 25 million. So someone has to take the assets out of, let's say, in this case, your public equity investments, raise the cash, wire the cash to that particular fund for that commitment. And that takes place. So in terms of implementation, does take administrative work to make that happen. The partnership uses it, the GP uses it, invests in these underlying partnerships, and then the ball starts rolling. But how much do they make in terms of the appraisal value? You know, it's a new investment. They're going to carry it at cost for a period of time, right? So that you're paying fees, but your NAV really isn't going up during that period. That's called the J curve, because when you look at the valuation, you see that it's negative at return. And it is until 3, 4, 5 years out that you start seeing the appreciation and value of that investment. So the NAV goes up, then you start seeing that increase in years 4 or 5, et cetera. And then you start receiving distributions accordingly. Okay, so the idea here is it's lumpy. It's not like public equity where you give the money and you're fully invested. It takes place over time.
And this is why you have to keep putting more money every few years, because you want to keep the level of your allocation at the top of this kind of this mountain here. And so because the fund is not perpetual, because it goes up and down, you have to keep putting it, you can stay at that target allocation.
Page 1141. These are the types of investments, the underlying partnerships that you invest in. Again, the idea here is you're investing in companies that are in different stages of the growth cycle. So one is maybe buyouts, and that typical range is 40 to 70% of the portfolio will be invested in buyouts. If you go with the general allocation, right? It's kind of an institutionally balanced private equity portfolio. And the idea here is that a buyout is a mature company that has struggled and its valuation in the public markets is less than they think it should be. And then you have someone stepping in and say, we're going to buy the public equity of this company. We're going to take it private. And we think that we can re-engineer the company, make changes to make it more profitable. And then we maybe go back out to the market once we've instituted our changes, maybe change management, make strategic decisions, and then go into the public markets and earn a premium. So that is the less volatile component of a private equity portfolio, if you will. Venture capital is the other category of investments, and that tends to represent, let's call it anywhere from 15 to 40% as a typical range, but more than that, depending on the particular manager. This is where you're investing in startups. So this is where you're seeing home runs take place. There's also, distressed restructuring companies that you invest in and private energy. So if the fund of funds, this manager is going in and it's investing in a various number of partnerships, typically 29 to 30. So you have that diversification. That is the kind of the one-stop shopping for you all as an investor to get that exposure.
And I'll just add that what John just mentioned about the private equity manager having that input into how the company is run is a big difference from public equities. In public equities, they're buying a company and they're judging the management. And then if they don't like it, they're selling it. But in this asset class, the private equity manager actually has a say in how the company is managed. So that's another difference about why they can, they have that return premium. It's more control.
Next slide, 42 in the iPad, 12 in the deck. Again, this just highlights some of the challenges that exist. So we understand you're getting a premium, right? What are the challenges? Well, one is, again, locking up capital 10 to 15 years. Implementation, manager selection is critical. And then we talked about fees. Benchmarking, so the difficulty is when their appraisals come out and you look at everything else in your portfolio that may be doing particularly well or particularly poorly. You've got a lag reporting period. One, you've got less frequent valuation of the company. Secondly, when they're published, you're looking at a 3 to 6 month lag. So again, you look at it and say, oh, my private equity is doing lights out and my public equity is suffering. Two differing valuation periods to try to, it's contained within the same report, but they're really marking it at different points of time. And that's certainly a question that, we address, and it's one of the perils of it. But, I go back to 6:30 of last year where you had significant differences and you're saying, okay, so we're doing great here. We're doing terrible here. I'm like, no, that's, that lack of synchronicity in terms of the reporting, the valuation comes into play, particularly when you're generating an annual report. J-curve effect, we touched on that. And then again, program complexity. It's more complex than investing in public equity, no question. It takes staff resources. You also bring on legal to a greater extent. But the use of one vehicle fund-to-fund manager, it's manageable. And in terms of like what you're doing on your private real estate front, there's similarities. So that kind of provides the educational background. Happy to answer any questions that are outstanding. Questions?
Madam Chair, may I have your tolerance? I'd like to ask Carlos about 3 questions. if
Sure,
I may.
go right
With
ahead.
your tolerance, thank you so much. And board, please forgive me. It's seasonal allergies, I swear, but it seems to be worse today than it was yesterday. So I apologize. Carlos, do me a favor. No one is a stronger advocate for private equity than I am here because of my experience working on the teacher's retirement pension plan. But when we were getting into real estate and farmland, there was a sort of, you presented to the board sort of a timeline. Have you had a chance maybe to examine that? And my first question's got 2 parts, Madam Chair, my apologies, but also there's a lot of conversation and it needs to be about liquidity because these are really much bullet-like structures, right? You don't get your principal back until 12 years down the road. And I've noticed page 15 on liquidity consideration. So my first question has 2 parts, timeline. And again, I did hear that this portfolio is in a good place, but has there been a cash flow liquidity sort of study? Have you had a chance to do that?
We have, I know the presentation you're talking about because we looped in Avery at that point where we gave them the value add real estate and the farmland and what we proposed. So over time, we said we were going to move money from point A to point B to fund everything. I think we've kind of touched it, but I don't think we've done, I know we haven't done a full in-depth movement of cash.
Well, with the farmland, you already had an allocation to real assets. So what we did is it was more of a structural thing where we said, okay, well, you have 16% to real assets. How do you want to allocate that?
Okay.
And that's when we put together the farmland and the pacing study, which would be the next step after, if you decide to go forward with private equity, that would be the next step. So let's figure out how much we're going to put in for the next, each year.
Am I hearing you want to see a proposed pacing?
I think it, and again, no one wants to hit the gas pedal worse than I do, but I do think it would be good for this board. The old saying, measure twice, cut once, to make sure that we look at that and it's presented before the board, just to make sure that we understand that. Yes, I would prefer that. Madam Chair, may I ask my second question?
Ready.
So, Carlos, back in October when we had the educational seminar, and I hate to almost go down this rabbit trail, but I made a note about private credit was mentioned. And again, as we continue to look at possibilities to diversify the portfolio of APERS down the road, is that something that's even on your radar screen? Is there interest in that? I'm curious.
I think the private credit, we had a risk reward graph on there and we showed obviously the highest risk was private equity. And somewhere a little bit above domestic equity, international equity was private credit. That is an asset class we do not have right now. It is one that's been on my radar and I've been kind of looking at it. Quite honestly, it's we could look at it for you. I don't think the timing is as good for it right now as perhaps private equity, and I don't know if John or Brian have an opinion on that.
You know, what I've had some clients do is allocate to private equity. They have that allocation. And you asked about liquidity. So let's say you decide a certain level of private equity, you have a liquidity budget. Maybe within that private equity program, you look at private credit managers as well, where it makes sense. Or we have clients that do, when they look at the asset allocation, they have private equity, private credit as separate allocations. So there's a couple of different ways we can look at it. But to Carlos's point, I think the timing might be a little past, but I wouldn't say that an absolute no.
From a liquidity standpoint, private equity, you keep hearing 12 to 15 years, right? Private credit, 4, 5, 6 years.
Yeah, a little
Lock up.
shorter.
I'm sure, man, it's my last, and I swear to the board, this will be my last one, and I appreciate everyone's tolerance. So in the state treasury, when we started diversifying the portfolio and adding on, we got to a point where we sort of piecemeal, and we needed to hit the pause button and take a look back at the asset allocation overall, maybe 100,000 foot level, because you can really get down in the weeds. When is the last time, as an overall asset allocation study, have we done that?
Before the one we kind of did today, 2018,
2019.
2019.
Okay, so we're 3-4 years from having done that.
Yeah, and so we brought that today, asset allocation.
Yeah.
The one we did in 2019 was what we call an asset liability.
Okay,
That's when we take the actuary's information and model it out. Those are less frequent, and they're working on an experience study. And so
Right.
usually after that, that's when we would do that, because we have kind of a real updated actuarial information to go on.
okay.
Yeah.
Thank you, Madam Chair. Thank you for your
Thank you.
comments.
Yes. Any other questions?
Okay, then we'll turn it over to John Perone to discuss modeling.
Yeah, it's first, John Perone, the Cal, the San Francisco office. Pleasure to meet you all. I do have a little bit of connection with Arkansas. That's my cousin she's a CPO over at, I guess, the Catlett law firm here. And then my aunt and uncle, he was a physician that retired and lived in El Dorado. So I got to see him last night. So it was pretty fun. But so where we're going to go here, John talked about some of the philosophical considerations about why you all might want to include private equity in your portfolio. And so I'm going to take a look at it from your specific portfolio. And again, I think it's kind of linked to one of Jason's questions, right? How, for our portfolio, what is the potential implication of adding private equity in terms of its impact on obviously both expected return and risk? Okay, so that's where we're going to go over the next few minutes. There's a lot of numbers here, but I'm really going to try to emphasize kind of the big picture in terms of what are kind of the key findings and considerations. We can obviously go down in the weeds as much as you all want, but again, for a big picture, trying to convey the idea that we feel from an investment perspective that adding private equity is going to be accretive to the APERS portfolio. And indeed, it's possible to add private equity in such a fashion that you aren't increasing the risk of your portfolio, because you could, in the process of adding the private equity, you could actually add additional allocation to some of the more conservative investments in your portfolio, like fixed income, to because private equity is going to be higher risk if you add more to fixed income. And we'll see all this in the numbers in a second. I'm just trying to convey the intuition that it's possible to, again, kind of keep y'all's portfolio level at the same level of risk it is now. Okay. So here's where we're going to go. So first, we're going to look at current portfolio. What is Callan's projection for what y'all's expected return is going to be? And here, we're not talking about what the return is going to be over the next week or what next month, that we're talking about over a strategic planning horizon. So think about everything I'm saying in terms of these numbers is what you'd expect over a decade on an annualized basis. Okay. And so that's where we're going as we get to page 44. So again, you see a lot of numbers here, but the intuition is, and Carlos alluded to this in his remarks, that, if we look at y'all's portfolio at the start of, say, 2022, remember, interest rates super low. Equity markets obviously pretty high, that the expected return of your portfolio was significantly lower than it is today. Because what's happened today, interest rates have gone up basically 2.5%, 3%. So and it's kind of a good news, bad news thing, as y'all know, right? It's painful as you go through that transition from a low interest rate to high interest rate environment, because obviously the bond prices are declining precipitously. But again, we're trying to look forward from where we are, on November 16th, right? And you look at the fixed income asset class, far more attractive in terms of prospective returns than it was a year ago, right? And you see that just looking at the table where you see asset class fourth down, fixed income. Now you can see we're projecting about a 4.5% expected return, again, on an annualized basis over the next decade. And think of that as kind of your, Barclays aggregate kind of core bond portfolio, all investment grade. Okay, so you see that's gone up materially. The other kind of key thing, and then if you look again, looking on your hooded portfolio, the primary constituents I know are the fixed income piece, right? It's about 18% portfolio, and the balance, like you think of that, the equity. Those are kind of the two main drivers right now of the portfolio performance. Okay, and so it's the same story in terms of better prospective returns, not to the same magnitude, but it applies to equity as well, right? Because again, we think over the course of the year, a pretty material hit to equity returns. We saw that obviously in the upstream presentation. So what that means is, valuations are lower now. So if we're projecting the expected return from today going forward, you can see it's incrementally higher than what we had at the start of 2022. So equity, you can see, is up about 0.75% based off our projections. Okay, so again, both good news, and we're going to see on the next page how that plays out in terms of your portfolio. One last thing, let me just, I probably need to make a couple remarks on inflation, right? It's obviously top of mind for everybody, all right? And so again, first thing, we're thinking about this over a 10-year horizon. Okay, so we have increased our inflation forecast over that 10-year horizon. Like again, the start of the year, we were 2.25 in terms of our projection. And now we've raised that up to 2.5. And it turns out, it's funny, I was doing an exercise last night where I looked at the realized inflation for the US over the past 10 years, 20 years, 30 years. It turns out, irrespective of those time rises, it's going some kind of quirk of the numbers and the time rise. It's been 2.5% now, the historical inflation over all those different time horizons. And then you look on a forward-looking basis, you think about what the market's projecting in terms of forward-looking inflation. One thing we like to look at is like the TIPS market, for example, because the TIPS market, the Treasury Inflation Protected Securities Market, that embedded in the yield difference between a nominal Treasury bond and a TIP of the same maturity is the market's implicit forecast for inflation. So if you look at the 10-year horizon, that forward-looking perspective is about 2.5% as well. So we're kind of getting 2.5 historical basis, a forward-looking basis. And last thing, kind of say a philosophical basis, right? We all know the Fed's target is a 2, they're trying to hit a 2% inflation target, right? But pragmatically, right, are they going to be so dogmatic about trying to hit that 2 number that they're going to tighten until they totally potentially wreck the economy? Like we think kind of if the slippage is probably at the end of the day, hey, we run at 2.5 instead of 2 over longer horizon. That's okay, right? So we're kind of triangulating on 3 different ways to think about it to kind of go to 2.5. And again, why I'm kind of dwelling on this 2.5 is actually an important number in the GRS information. Like I think you're all going to get the actuarial information coming out in a few minutes. But let me just pause there because I said a lot of stuff. So there are probably some questions. So let me pause and see if there's anything kind of on like the background and framework before we get into the stuff.
Questions for John?
Okay. Okay, very good. Okay, so now we're on page 45 in y'all's iPad. And pretty intuitive, right? I said expected returns today are higher than they were before. So this is how we model y'all's actual asset allocation you can see with our new count numbers, we're about 7.1% expected return portfolio. Okay. And again, Carlos mentioned there's been kind of a historical disconnect in terms of what the count is projected for the portfolio versus the underlying actuarial assumptions. And now you can see here, these things are almost perfectly harmonized, right? That's so you see, I put a little box around, okay, here's Cowan's assumption at 7.1. And it's important. And you can actually take that 7.1 number, that's like a total return number, and you can actually decompose that into two pieces. You can decompose into an inflation component, okay? And you see that we're 250, GRS is 250, and then what's left over is that real return component, okay? And so you can see again, I'd argue good news, right? That we're that synchronized here, and now actually Cowan's price inflation number 250, that is actually exactly the same as what GRS is here. So I guess big picture. Okay, current portfolio looks like, it's in the ballpark on average to deliver the return that the actuarial return. Okay, but again, we'd argue that some incremental allocation of private equity has the capability to actually incrementally increase that expected return without adding risk. That's where we're going here. Okay, so before that though, before we kind of get to the action modeling, and this is, I think, linked back to one of Mr. Brady's questions again, in terms of liquidity. And yeah, that you are tying, there's no ambiguity that you are tying up your capital for, let's say, 12, 15 years with a commitment to private equity. And if you try to get that money out before then, you are going to get a huge haircut. Like something like private equity is the last thing you would ever want to sell when, for example, when you're trying to come up with the cash to make your all's benefit payments. Okay. But what I would say is, I think there's good news on this front. And Mr. Brady, we're certainly welcome to put our pencils down and kind of tighten up some of this modeling to give you all comfort. But let me just tell you from a high level, that right now, your all's liquidity, I mean, you have about 16% of your portfolio, I call it illiquid right now. Okay, so that's the private real estate allocation, right? The timber and the farmland. Okay, and so compared to other large public pension plans, I would say they tend to settle more in about, let's say the 30% liquid. So you all have about half, I'd say, a typical large public plan in terms of liquidity. And it's okay to do relative stuff, but at the end of the day, it's, do I have enough money in my plan to make the benefit payments, right? So it's good to compare, but it really have to be specific, right? So I list out three things that I believe give us comfort in terms of y'all's liquidity considerations. So you guys have a strong funded status, north of 80% on a market value basis. That John Jackson was talking about. He's Chicago based. That's all I'm going to say on that. But there's a lot of clients in that area, right, that are very, very fiscally challenged, and we have aggressively come down and said, guys, you cannot put any more private equity in this portfolio. You got a plan that say 35, 40% funded, you don't know if they're going to make it 15 years, right? So anyway, so point one, funded status support of a private equity for y'all. Second point, and Mr. Brady, this linked back to what Brianne was talking about in terms of about every 3, 4, 5 years, we do detailed modeling on both your assets and your liabilities. And one of the outputs of that exercise is we can do projections for what the plan's net cash outflows are on a year-by-year basis. And all that is, guys, is just the difference between the benefit payments you're paying out and the contributions that are coming in. That difference is the net outflow. And so it turns out, and I went back and reviewed some of the modeling we did back in 2019, that that net cash outflow was about 3% of assets a year. Okay. And again, just to put numbers on that, and Carlos, you might say if this kind of feels right based off your current situation, but the net cash outflow, 3%. Let's call the asset base $10 billion. So that ties out to so it's about a net cash outflow of say $300 million a year. Does that kind of feel?
360.
Yeah, okay, yeah. And again, this is stuff that was 4 years old. So you're getting 3.6 as opposed to 3. So yeah, again, high level, we would say this level of cash flow is modest. Just as I was just looking, for example, so we got to pay $300 million net out a year. I mean, I'm looking here, you'll have $600 million in the S&P 500 index fund, which has daily liquidity, right? So again, just trying to make a practical demonstration from a portfolio liquidity standpoint. Like I don't see any issues there, Carlos. No. And then the last piece, and this is really important, is that now I talked about the net cash outflows being the benefit payments minus contributions. Those contributions have to be a real number, right? You all have to, you guys have a demonstrated history of making the contributions, right? And again, which gives us far more comfort on that front than again, let's say the Chicago-based plan that says, well, I'm going to put X in, and then maybe they put in 50 cents on the dollar, right? So again, that I guess it's a combination of those three things that, again, in our estimation are supportive to say something in the range of a 5 to a 10% allocation to private equity at the portfolio level. But let me pause there because this is a really important point, right?
So that's a big, more than 200 million. That's a.
Yeah, so-
100. Oh, that's a.
Yes, sir. So we'd be talking, again, let's use, I think the most recent.
$1 billion.
estimate. Yeah, so
10%.
half a billion to $1 billion would be 5 to 10%. Exactly. That's right. Okay. Okay. So now we're getting to the, yes, sir.
You had mentioned, Mr. Brady, about the teachers fund, how much they have. What is their percentage of?
If I remember correctly, it's 12.5% is their asset allocation.
Beyond, so we already have the 16% in illiquid assets. You're talking about purely the private equity that we talked about.
I do not know what their overall illiquid asset allocation is. I wouldn't want to tell you that. 'Cause I don't know what.
And in terms of what we've been talking about, it's the 12%.
Yes.
Okay.
They have real. They have private equity and I believe they also have real assets.
Yeah.
So we only have real assets here at 16 and then no private.
In addition.
Yeah, and that's kind of where I was, I kind of gave you a ballpark of kind of 30% of liquidity. So that would be a sum of real assets, the private equity, to the extent they say they have hedge funds or other things, the aggregation of those things. So. Okay. All right. So now we're going to jump to the actual modeling. So thanks for your patience, but if you don't know what the numbers are, they're under the hood in terms of the modeling. It's not very useful for you all. And I guess to that extent, there's probably one last thing I should mention is that we're modeling private equity as having a 1.5% premium relative to say the S&P 500. Okay. And John showed some, like if you look in empirical evidence and history, it's the most plans have been able to get kind of north of that 1.5% premium in terms of historical realization. But again, we're trying to be conservative here. Like I think the investment case here, at least from a modeling perspective, is so compelling. We don't feel like we need to be overly aggressive on the assumptions. It's really this combination, like private equity is going to be your highest expected return asset class. Okay. It is going to have a higher risk than public equity, but you're going to get some sort of, I call it modest diversification benefit from adding it. At the end of the day, public equity and private equity are still kind of the same flavors of each other. So it's not like you get a diversification benefit like you get with equities and bonds, right? Those are kind of oil and water. Those are different, right? Those really diversify each other. But again, it's that combination of effects is what you see on this chart on 47. Okay. And so And just to orient you all, you see this current policy, okay? No, y'all don't have any private equity right now. And so you can see this dot is plotted in terms of expected return, right? That's the vertical axis. And then the horizontal axis is the risk. Okay, so remember I said that your current policy had expected return of about 7.1%. So I'm just trying to orient y'all in terms of where the dots are. And you can see that risk is about 13%. And that risk, here we're talking about risk as in terms of standard deviation of annual returns. But again, I guess what I would argue as a metric is think about where your risk is right now. And so what we've done is construct portfolios of private equity, kind of keying off your current level of risk. So we want to go up, right? It's as you add private equity, you could say, hey, well, I want to have private equity, but I want my portfolio to have lower risk. Or I could add private equity and have higher risk. That we thought that I think centering on the idea of going straight up in terms of let's try to get a higher expected return at the same risk. There's got no ambiguity, right? Your portfolio has a higher return per unit of risk than it does now. So it's, at least from a modeling perspective, that means it's better. Okay. So we're going to look at and again, I'm just trying to illustrate the concept here. We're going to look at what's under the hood in the portfolios on the next couple of pages. Okay. So here you are, 7.1%. Now, if we go to this mix 2, you see how there's a line with 5%, private equity. Okay. So these are portfolios, again, that have 5% private equity. So it's possible a higher expected return at the same risk. That's what that mix 2 is. Okay. And then just to complete the story, we've also done an exercise where we're adding 10% private equity. Okay. And you can see that depicted there. And so just kind of rule of thumb that at least based off our modeling, if you add 10%, or excuse me, add 5% to private equity, you're adding about 10 basis points or to your expected return. So it goes from 7.1, 7.2 expected return. Same thing as if you went from 5% to 10%, you're adding another 10 basis points of return. So it goes from 7.1 to 7.3. Okay. And you might say, well, 7.1, 7.2, that sounds like the same thing, John, but remember, we're talking about these tenths of a percent on an asset base that's $10 billion, right? So if we're talking about a 0.1% return on a $10 billion asset base, we're talking about potentially increasing the expected return on a dollar basis by $10 million a year, right? So this is very material potential impact on the portfolio. So I just want to underscore that. Yes. Oh, I'm sorry. Okay. Okay, got two last slides. Okay, and so that's just kind of the actual demonstration of what's going on here. That let's look at the 5% case. So it's a mix 2. Let's focus on that mix 2. And this goes back to the judge's point is in terms of, hey, if we're going to add private equity, where's the money going to come from? What kind of time horizon would that be, right? So what you see here in terms of these changes, this would happen over a protracted period of time, right? So it's the point being that in this 5%, let's say we're adding 5% to the private equity. Yeah, the predominant funding source we would suggest would be from likely from convertible bonds and to secondary extent, or as well as the international equity piece of the portfolio. And again, this is not meant to be prescriptive, right? We can always come back and show you some different things, but top level, we're trying to show, hey, we think that adding private equity can increase y'all's expected return at the same level of risk, and here's one reasonable way to fund it. Right. And then kind of just to complete the picture, let's just look at the on page 49. And again, let's focus on that mix 2, which again has the same level of risk as your current portfolio. So again, now you see the portfolio expected return goes up by 21 basis points here in that situation. And when you get to a 10% level of private equity, that funding source, it really needs to be your public equity for the portfolio to not jack up the risk of the portfolio. And you actually need to add a little bit of fixed income to kind of mitigate the additional risk that private equity is the portfolio. But I would say, hey, going back to what I was saying at this, my start of my remarks, hey, where we are today in terms of fixed income with the expected returns of 4.5%. Hey, I got no problem adding more fixed income to my portfolio because it's the biggest diversifier in the portfolio. Now I don't have as much kind of haircut or loss opportunity costs from, I like something the conservative's going to give me 4 or 5%. I like that in there. And again, by adding a little bit of fixed income, you can see in this analysis, you're actually completely offsetting the additional investment risk that's coming from the private equity. Okay. So again, I know, a lot for y'all to digest in a short period of time, but hopefully y'all see kind of the key message that, again, from an investment perspective, we think there's a very sound case to add private equity here.
So if you look at the different mix, and I have slide 48, 5% private equity mix. And to John's point on risk and reward, think of the map of the United States, right? So our risk and our rate return is St. Louis. The goal when we did the study was to get us up to Des Moines. I didn't want to move far right on the risk strategy. So private equity, it's in Maine, right? So our overall portfolio is 7.08 right now. I wanted to move up north without moving to the east. That helps you. And I think we accomplished that with some of these mixes. Because if you look, the standard deviation, the risk, we're currently 1284 and mix 1 is 1207, mix 2 is 1280, mix 3 is 13.16. So we really didn't move the risk. Now on the 10% allocation on the next slide, it's a little different story. So 1284 risk, all the way to mix 3 on the right, 13.25. But even mix 2 is still 1288. The risk didn't move.
When you say 10%, you're referring to 10% of the portfolio?
That's right.
It would be about $1 billion.
Exactly.
How quickly could you get to 10%? So evaluating projects.
You say 5 years, 7 years?
5 to 7.
Okay, yeah,
Yeah, it's gonna take a long time.
But I assumed it would take place. But we haven't gotten into this, so I haven't really thought it all the way through. Okay. Thank you.
A question from Dr. Lane.
So thank you, Madam Chair. So this makes sense. I've been thinking on it since it was brought up, obviously in teachers. And it all of a sudden it hit me, hey, we're not doing it over here. Why have we not done it over here? But why is this the first time the board's hearing about this? I've been on the board 8 years. Was it, and if it's an awkward answer, don't give it.
So after the 2008 global financial crisis, the fund was down over 33%. And the board at the time wanted to add a little more octane to the portfolio. And that's why they created the diversified strategies portfolio. And as it turned out, they had a foot in 2 canoes. One foot was in adding more risk. The other foot was in don't want to add risk. So it was just the pleasure of the board at that time.
And we did discuss it at the 2019 study. We introduced the concept and there just wasn't a lot of interest at that time in pursuing it. So glad that it came back up. We're talking about it now.
Go ahead.
Thank you. Let me backtrack a little bit to 16% of our allocation is to illiquid assets today. And I'm trying to compare relative illiquidity. That's probably not even a word. Trying to compare that to what we're talking about with private equity, which you're saying would tie up that equity for 10 to 12 or 15 years. On the the percentage that is already in illiquid assets, what does that timeline look like if we needed? Because what we're talking about is tying down about 25% of the total portfolio, right?
Exactly.
And so if we talk about private real estate, timber and farmland, is that also tied down for that period of time? I wasn't here when
Yeah.
decisions were made. I was curious how tied down is that percentage?
So we call anything that you can't sell tomorrow is illiquid.
Right.
So within your real assets portfolio, you have some of these closed-end real estate funds, which are the 10-year timelines. And then you have some other funds that we call core real estate, which technically have quarterly liquidity, except when you need the money, then it's longer. So for instance, right now, if you put in for redemption from your core equity managers, you might get that money in a year. Because when the real estate markets are stressed, you don't want the managers selling off assets just to give people money. So every quarter you have the chance to ask for your money, but they give it to you when they have it. So it's illiquid in the sense that you don't have control over when you get the money back. But those are not 10 years, you could get out maybe in 2 years at the most, if you're in a challenged period. So it's not quite
So
as long.
you could plan for a rational shorter horizon to get those funds back
Mhm.
out of this illiquid status.
Mm-hmm. Yeah, so it's not all 10, 15 years, but not tomorrow. If you needed to raise benefits, you would get it.
And some of the real estate managers, TA Fund 12, it's been a shorter price than anticipated. They've been returning capital fairly quickly. So even a closed-end fund like TA Fund 12, I assumed 5 to 7 year lockup, and I think they'll redistribute capital before that. And remember, we're talking about locking up 5 years, so 5%. It's not all going to be locked up. At any given point in time, if you ask me how much we had locked up in private equity, it won't ever be 5%. Because they're always calling capital. If they sell a business, they could return capital. So I don't think it would ever be truly 5% number.
But that has to still be committed though, right? It's
Sure,
Yeah.
So sure, you have to treat it like it's tied up.
Yeah,
Right.
pretty much.
exactly. You do.
Madam Chairman.
Jason, go ahead.
My tolerance, and I go back to my first question that I two-parted, and maybe I shouldn't have done it on a timeline. So even if we said 5%, $500 million, it takes 3 to 5 years. But even if we gave you permission today, and again, I'm not advocating that because I need the board to really be on board with this, but even if I did, you would have to go find a manager. And even if you found a manager and y'all went through 1,000 scenarios and came down to 3 or 4 to bring to this board, it could probably be late 2023, early 24 before maybe the first recommendation could be brought to this board. I know I'm putting a gun to your head and I apologize, but I want to get back to a timeline because I do think it's very important for the board to understand this isn't let's go with trade, hit the Bloomberg and we're buying Walmart stock tomorrow.
Yeah.
So can I just throw that at you and let y'all tackle
We've
it?
talked about different scenarios. I mean, the next step is the pacing study. So that's just saying, how much are we going to allocate for every year for, say, the next 5 years? If we want to eventually get up to the 5%. So that's the next step. Then it's also a manager search. Now, we've been talking a lot about doing fund of funds. And so, yes, we would then do the search. So much like what we did for international small cap. Okay, we do the search, we come back, we have some finalists. In the search, you can decide who to interview. We do the interviews, we commit to the fund. And then that takes some time for the paperwork. The only thing that makes this a little bit different is that certain funds are only open certain years. So let's say there's a fund that we really want you to take a look at, and they're closing, we might bring them in, or vice versa. We know a fund's coming out next year or something like that. So it's a little bit more nuanced than what we did with the international small cap, because you can give them money almost any time. But yeah, it's not like this is tomorrow, it's going into the portfolio.
Madam Chair, thank you.
Other questions?
So why would it, I'm sorry,
Go ahead.
no, someone up there's wanting to talk.
Okay.
Madam Chair,
Yes, sir.
Daryl Bassett here. Listening with great interest on this, and of course, I think private equity certainly gives us some opportunities for our portfolio. But my specific question here is, as it's been brought up, 16% of the portfolio now is illiquid, primarily in real estate, timber, and farmland. Clearly, we're going to have to reorder some of that in order to get to this 5% there. That's going to take some time to unravel those. And so again, I'm getting back to timelines. If we're saying 5 to 10% of this is going to be private equity, then that clearly means a reordering of our portfolio. Has any thought gone into what real estate, what timber, what farmland, and whether or not we're going to be able to get out of them? Are we going to be selling at discounts? Where are we looking at in doing that? Getting in, getting out is one thing, but are we looking at having to sell at discounts? A similar scenario that we would be facing if we got in private equity. Obviously, our capital will be locked up for 10 to 15 years. And if we sell out of that, we would be looking at selling at a discount. So are we looking, when we start reordering our portfolio out of real estate, timber, and farmland, are we looking at having to sell that at discounts?
Mr. Bassett's Carlos, the answer is no. I wouldn't raise any cash for private equity if I'm a forced seller in any of our current investments in real estate or farmland. So the target in this particular case would be international equities and convertible securities. That's where we propose to raise the cash for private equity.
Well, I agree with those two components. I mean, we can stand it from those two components. Absolutely. So, okay, that answers my question.
Thank you.
Other questions?
Does anyone- I was looking to see if anyone out there saying, so to me, it makes sense to go ahead and start the first part of the study now. If we're looking at, you're not going to be able to come back till spring. I mean, we meet quarterly. So I'm thinking we need to get on the slow bus now. I mean, it's going to be a slow rollout, so why not start it? But I don't know what that motion looks like. If the motion has to be to agree to invest, or if the motion has to be for the next study. Please excuse me, what was the name of it?
The pacing study.
Pacing study. So which comes first? Say that again, pacing,
So,
PACING. Okay.
yeah, the pace at which we're putting money in.
Okay.
So what we would need to know kind of if you're looking at the 5% or the 10% allocation, because that will change how much money you need to put in. We could either pick one of these mixes today, or we can come back with a pacing study. And you can see how much we put in each year.
Okay.
Yeah, so there's different.
Yeah, really practically speaking. So if we were to make a motion on one of these and start a pacing study, and this is the tricky question, because it's gathering information still is, are we locked in to the 5% at that point, or they come back with the pacing study and we go, you know what? No, we're not going to go with it. I hear the word study and I don't hear locking in. Okay.
You would not be locked in.
Okay.
Madam Chairman, I don't see where we have we agreed, and I'm sorry, I missed the first 30 minutes of the meeting because I was in another meeting. Have we agreed to even the construct of an investment in private equity? Are we past that point yet? Have we agreed that this is what we want to do? Have we had a vote on us actually participating in a private equity?
No.
No, we have not.
We're in the discussion.
I would think that we would have to agree as a board that the construct was something we wanted to pursue before we start actually trying to set allocation amounts and decide on mixes.
Yeah, I would say the pacing study is probably not going to change your opinion about whether you want to do private equity or not.
Yeah.
It's just the next step in the process once you decide you want to move forward with it.
We just need to pick which allocation we want to do the pay.
Right.
Beyond.
Right, and so we've given you, 6 different choices here. That's a lot. We tried to keep, give you options, keeping risk the same. But yeah, I would say that, the information we're presenting today is not going to change in February. The pacing study will say how much you're going to commit to the max that you choose. That's really all that's going to tell you. So because you can't get totally into that allocation tomorrow, and we want that vintage year diversification, we just give a little bit each year. And the pacing study is just saying how much money you want to give each year. So it isn't really going to, I think, change your mind about whether you want to do this or not.
So we can continue to marinate on that part of it, but start gathering more information for when we do make the decision.
Right.
That's
So
the way-
it means the process is installed. We can keep moving forward
At-
and then you can finalize it.
Gary,
Are we saying that, or underneath all this, are you telling us that if we don't do this, we're going to have to lower our target return from
Assumed rate of return.
7.15%?
No.
Are you
no.
telling us that?
No, sir. It's, it is, yeah, for a variety of reasons, you're never gonna have complete harmonization between what Talon projects for the portfolio and what the actual numbers are. And I would say you're going from a starting point where there was a disparity at the start of 22, there was 1%. And it may impact, hey, maybe we need to be a little more aggressive to try to get more toward the actual number. But now I would argue this is about the most synchronized in terms of the actuary and the consultant that I've seen, work on this stuff for a couple of decades. So they're emphatically no. But that said, go ahead.
Rita and Heidi can weigh in, and they're going to be up right after us, so they can tell you about
Right,
that.
I know that.
And
So
it's their-
following though, okay, so if that's not the case, are you telling us that if we do choose to invest in private equity, that we can increase our return? Are you telling us that?
Potentially.
Potentially.
Projected return.
Projected return, yes. Because it goes back to the slide that had the longer term numbers and how much private equity outperformed public equities. So I think the 25-year return was 15% versus 10. So yes, in the long run, definitely possible.
This is just.
Could I ask, at the school board, did they see that made it a higher rate of return by investing in private equity with the school retirement system? Did that?
My observation of the returns were this, is that in the bad years, when just 2 years ago, when equities were in the negative, private equity was in the positive. In the good years, when equity was hitting 30%, private equity lagged a little bit, but it was still in the mid upper 20s. That's the best that I can recall to my memory. So it had a lagging feature going, a positive lagging feature going down. It had, I guess you could say, a negative feature when equities were going up. But it was like vanilla and chocolate ice cream, not too much of a variant, but it was in the same portfolio sort of. So I don't know if you would agree with that sort of mix.
They've had it, teachers has had it for a while.
Yes. Since
So you'd have to
2007.
far back to find out what the actuarial rate,
The effect.
maybe, I don't know if PRS knows
The
that.
change. I mean, ultimately, that's a question, right? How can we make more money from our investment
And
without too much risk?
correct, and the way we invest, the whole focus of a retirement fund is long-term. I mean, that's what a retirement, I know I'm dying, so my 401k, I mean, not dying imminently, but I mean, I know, I'm got a cutoff, so I view that differently than I view a retirement fund. So I'm gonna jump in there. I would make a motion that you do a pacing study for the next meeting, which I will not be at, but I might log in online and just watch what happens for the mix 2 of 5%. That was my comfort level. I'll just be honest. 5% mixed two on page 18, and that you come back with a pacing study for that. That would be my motion. Is that a proper motion, Madam Chair?
For motion, I have a motion to do
I
a
would
pacing.
second. I would second, Madam Chair.
I have a motion and a second on the pacing study on the 5%. Yes, next two. Good point. Any discussion?
Just a, okay, so basically you were saying a while ago that the pacing study, they needed to know where to go. So, and we were talking about, and Mr. Bissett brought up the fact about deciding whether we're going down this road or not, right? But this is a study, I agree with her. So we're just looking at numbers. And if we look at 5 and we don't like that, is there a problem going back and saying we want 10 before we do this, or we won't look at 10 before we do this? Or I know it's a lot of work. I'm not trying to, but
What I'll say is, the pacing study won't change or shouldn't affect your 5 or 10% decision.
Yeah.
The information to make that decision is here in this presentation. What the pacing study will say is year 1, let's put 250 million in a fund of fund. Year 2, let's put X dollars amount in a different fund. That's all it's going to tell you. So it's not going to say, I don't think it'll make your decision.
and so the reason I asked that, for me, this is, I like what I hear about this, right? But it's also 10% of our total assets, right? So if we were talking about $100 million, we'd be, you know, we're gonna, let's try this out, but we're talking about $1 billion. So that's my hesitation in this, not what we're doing, but the amount we're doing. That makes sense.
The one thing that you, will-
That we're talking about, yeah, I follow.
the one thing that you will see in the pacing study will show you year by year what your exposure is. So that you have some sense of one, what is my, commitment, what is the commitment amount and what is that going to look like? And how do I get to that eventual allocation of 10%? And if you think, oh gosh, and that seems like an awful lot in any given year throughout, that if you want to scale that back, then it's a matter of, then you're just reducing your overall target allocation from 10% to something less than that. But at least it's more definitive. Sometimes you get a different answer when people actually see the dollar amounts coming in and out.
Judge.
Yeah, Madam Chairman. Yeah, and I get to ask newcomer questions for at least. So I think the motion's a good motion because I feel like there's an opportunity cost if we don't start to put this in play, because it seems like this is a good, wise thing to do. The question, I'm still intrigued by the teachers fund. Because it feels to me like if that fund has been doing this since 2007, 2008, that there's an interesting benchmark there. That I'm going to guess at some point, there's been decks like this presented to that group that has shown how it was supposed to play out and what the returns were supposed to be, and your kind of your mountain chart here, how that played out. Is there any way to go back and just measure what they did and how it performed and how how they adjusted their mix? Just to see, since they're, right here. I'm just wondering if we couldn't benchmark that one a little bit, just from a practical standpoint. How did they make their decisions? How did they adjust their mix to accommodate that decision? What were the returns on those? How did it play out in terms of the dollars they set aside? How was that capital called as they had the dollars set aside? How were the distributions returned? Is there any way that we can go take a look at how that played out for them so that we would have some sort of roadmap for how it might play out for us?
So I'm sure you can get the performance because it's public information on their fund. What I'll say is looking at one fund as an example, usually we would say to look at more of a universe of different public funds. They are quite a bit bigger. So for funds of their size, we see more usage of private equities. That's why they have a longer time period. But I think page 3 in this presentation or 33 in the PDF. This gives you a better idea of the universe and how that, has performed. I mean, we can't go back and recreate exactly what they did or what they're doing. We can say, as a whole, when we look at the general kind of opportunity set, that, we do see a premium over a long period of time, but you wouldn't know that 10 years or so, kind of where you start getting in those final numbers from your first funds.
Yeah, I'll say, I talked to Arkansas teachers quite a bit. And I could certainly get the performance numbers, but what I can't simulate ever again is they were on the sidelines in 2007, ready to invest, 2008 hit. And they were lined up, ready to buy things cheaply. The private equity managers were. So I can certainly get their long-term numbers, but that is one scenario in the economy that I don't think we'll ever see again.
Yeah.
I think any sort of benchmarking would be helpful because it's been brought to this table that they are somebody who's ahead of us in doing this.
Sure.
Well, then let's find out what that means.
Sure,
Yeah.
I get that from Arkansas and other systems as well.
Madam Chairman,
Yes, go ahead, Chair.
to the point of benchmarks, I don't think we're going to get benchmarks. I think that is integral in private equity investing. I don't think there are going to be any benchmarks that are going to allow us to be able to look at that, because I think essentially the notion here that we're discussing, part and parcel of this is the investment into blind pool funds. And when you're investing in blind pool funds, there aren't going to be the benchmarks that I think my colleague is looking for. He can get performance numbers, but you're not going to get the benchmarks that I think you're looking for. And I don't think they're going to be able to tell you today that there are going to be benchmarks for this kind of investment. And of course, I make that statement, I stand to be proven wrong, but I don't think you're going to get those kind of benchmarks.
So I have a motion and a second on the table. Any further discussion on the motion? If not, all in favor of the motion, say aye.
Aye.
Any opposed, say nay. And the motion carries. Thank you very much.
That was a lot of work. Thank you, guys.
Yes.
Yeah.
Yeah, let's do this.
Oh, let's go. Okay, good.
Our director, Ms. Fetcher, will have a report on the class action settlement proceeds and ending report, and then we'll take a break.
Yeah.
On page 57 on the iPad, you can see by year, our settlement proceeds. This year, currently we're up to 90,000 captured proceeds. We are active in 10, so on the pages following that, I think you can see the ones that are being monitored and where we have any activity filed.
Got it.
And that's it, unless there's questions.
Any questions? Thank you. Let's take a 5-minute break and return to do our actuarial valuation result.
And we thank you, Madam Chair.
Recording stopped. Recording in progress.
I don't see anything there, so. Yeah. It's been a long time there.
Oh, yeah.
Liquor's made.
John.
Yeah.
Because he worked at the.
Oh, my God.
And they always accept.
That was funny.
Yeah.
I'd like to begin again. And we have a 2022 annual actuarial valuation results from Nita Ratzeloff and Heidi Berry of GRS. Glad to have you with us this morning.
I'm glad to be here. Good morning, everyone.
Morning.
Heidi and I are very pleased to be here to go over the results of the June 30th, 2022 actuarial valuation for the Arkansas Public Employee Retirement System. Remember that the board heard our preliminary results back in August and established a preliminary employer contribution. So one of the action items today is going to establish that employer contribution rate for APERS. In addition to establishing the employer contribution rates for this one group, small group in APERS that we call district judges. It's a group that came into APERS back in, I believe, 2005. So that's another responsibility for the board, and we'll talk a little bit about that. And we'll talk about some projections as to where the employer contribution rate potentially may go, depending upon some market return scenarios over the next year. With that, if we can go to the next slide. I think I just talked about the agenda. I think if we can go to 2 slides past that, Heidi is going to talk about the results for APERS. I'm going to discuss the results for the district judges. Then Heidi will discuss the results of the projections. After that, we'll talk about the actuarial funding policy that the board heard some discussions about back in October. I think there's an action item there if the board feels comfortable with adopting the revised actuarial funding policy and or any questions that the board may have with respect to the discussions that happened in October. We'd be more than happy to answer any of those questions. I'm not sure we'll be happy to answer any of the questions from the previous presentation, but we're more than willing to do so. I think the actuary came up much more frequently than I've ever heard in an investment consultant presentation, which we like to be heard about or talked about. But I heard that there were some actuarial questions, and we're more than happy to answer any questions that the board may have given Callan's presentation. Having said that, Heidi's kicking me under the table, so I think she wants to go on with her APERS presentation.
Okay, so we're on slide 69. The June 30, 2022 valuation determines your employer contribution rate for the fiscal year beginning July 1, 2024. As Nita already said, today, a couple of the action items are to determine or confirm the employer contribution rates for both APERS and district judges, as well as approving the reserve transfers from the employer accumulation account to the retirement reserve account and deferred annuity account. And there's actually a slide later on discussing this, so I'll talk about that in a little more detail when we get to that slide. So moving to slide 70, if we look at your participant data for June 30, 2022, active members increased slightly to 42,771 members with total payroll of $1.9 billion. On average, that increased by 7.8%. So it was a pretty big increase in pays. Looking over to the right with the retiree information, this would include retirees, survivors, quadros, and drop members as well. There were a total of 41,390 members who are currently receiving $671.2 million in annual benefits. As a percent of payroll, annual benefits are about 35%. Moving to the next slide. There are 36,728 members who participate in the new contributory plan. And that number includes people who elect in that plan. There are an additional 1,426 members who are in the drop plan with total payroll of 93 million. And the nice thing about what the system is doing with regard to that payroll is there are employer contributions made on that payroll. So that helps the system to fund a little bit extra every year doing that. Moving to slide 72, take a look at the investment experience for the year. And under the APERS asset valuation method, we use a 4-year smoothing method to spread out the gains and losses year to year. As of June 30, 2022, the market return was a negative 10.6 or 0.8. That's on the next slide. Negative return for the year. So 2022 was not a good year, but when we use the smoothing method, the funding value of assets actually exceed market value of assets by 517 million. So what that means is there's a $517 million loss that's going to be smoothed out over the next 3 years. So as this difference is fully realized and if near-term experience matches expectations, there's a little bit of a typo in these two lines. Contribution rate, because their loss is expected to be recognized going forward, the contribution rate would be expected to increase or decrease. Increase, sorry. Or your amortization period would have to increase to sustain that loss. So slide 73 actually shows how we develop the funding value assets for use in determining the employer contributions and funded status of the system. Rows B and C show the market value at the beginning and the end of the year. So it went from 11.1 billion to 9.7 billion. In E1, the market return was negative 1.2 billion. That's your negative 10.8% return for the year. We expected row E3 based on the 7.15% assumed rate of return of 698 million. So the difference between E1 and E3 is E4, and that's the amount that's smoothed out over a 4-year period. So F shows all of the different smoothing years, what portion is taken into account. And ultimately for 2022, we recognized $113.8 million in losses. So that gave us a recognized return of 6%, which is slightly lower than the 7.1%, and gives you a funded value of the 10.2 billion. We move to slide 74. The valuation assets totaled 10.2 billion. Actuarial accrued liabilities were 12.2 billion, so about a $2 billion unfunded liability. The funded ratio based on actuarial value of assets was 84%, which was the same in comparison to the 2021 evaluation. On a market value basis, the funded value is 79%. And you can see in the last valuation, that was 94%. That's because 2021, we had super high returns, 2022, not so good of a year. So that difference is adjusted based on market value.
And this is actually a really good indicator of why we do the smoothing process, the development of the actuarial value of assets. If the membership or anybody would have seen the funded ratio on a market value basis at 94%, everything's hunky-dory, we don't have anything to worry about. And then they see a funded ratio on a market value of asset basis this year of 79%, well, the sky is falling and things of that nature. When you smooth those gains and losses out over a 4-year period, then you see that consistent funded ratio of 84%. It gives decision makers, I don't want to say better information, but it removes a lot of the volatility that 1-year market value returns can have on the system's finances, and better decisions get made in that context, where something Last year, it could have been that, well, we can reduce employer contributions or some of the benefit changes that the board had tremendous deliberations on. Maybe they were inappropriate. Well, now this year, if you look on, the 79% market value funded ratio, well, now they look appropriate again and things of that nature. So that's why we try and look at things over not just 1 year, but over multiple years as well.
Okay. On slide 75, this just shows the historical actuarial accrued liabilities and valuation assets increasing over time. We'll skip to the next slide. Slide 6 shows the employer contribution rate, and again, this was shown in August and preliminarily adopted for the 15.32%. So it's split out between the normal cost, which is the accrual for active members for 1 year of service, plus the unfunded liability portion of the employer contribution rate, that $2 billion that's amortized. And in this case, we back into the amortization period to get to that 15.32%. So that amortization period is 14 years. Total employer normal cost, the total normal cost is 12.04%, but we subtract out the member portion, just 4.52 to give an employer normal cost of 7.52%. Okay, skip to the next one. The maximum advisable amortization period is 30 years. And again, for 2022, we're at 14 years, so we're well below that. Given current assumptions, an amortization period of 21 years or below results in an amortization that covers at least the interest on the unfunded actual accrued liability. If it were higher, we refer to that as negative amortization. Actually see your funded grow until it hits that 21 years, and then it would start to come down again.
Yeah, so on a nominal basis, for example, their unfunded accrued liability of being at 2 billion this year. If your amortization period was, for example, 30 years, the actual expectation next year, even if all assumptions were met, would be that our unfunded accrued liability would be higher than 2 billion next year. We're not even paying the interest on the unfunded accrued liability until we reach an amortization period of 21 years or less.
Slide 78. This is also in your valuation report. It's a historical schedule of some risk measures that we look at to try to help gauge the health of the system. So we have our funded ratio based on the actuarial value of assets and the market value of assets. You can kind of look at it historically. In 2009 or 2008 to 2009 on an actuarial value basis, it went from 90 to 78. Obviously, that was we had the recession back then, so it's been increasing. We've had some assumption changes in between, things like that, but that's we kind of want to focus on the trend of that to make sure the system's moving in the right direction. The amortization period is at the lowest it's been since 2008, which is 14 years. Again, we just recommend that not be above 30 years, and we'll talk more about the funding policy and some of the revisions that we had recommended or brought to the board in October.
And this is maybe a good stopping point to talk about how this intersects with the funding policy changes that the board's considering. So if you look at that column called UAL amortization period, you can see back in 2016, it was 21 years, but in 2017, it increased to 25, and 2018, it increased to 26. And that was to maintain the 15.32% employer contribution rate. The next year it dropped down to 24, then 23, but then it substantially went down by 7 years to 16, and then 2 years to 14. And that the board's underlying objective during those years was to maintain that 15.32% employer contribution rate. one of the suggestions in the funding policy is that $2 billion unfunded accrued liability we're showing at a 14-year amortization period right now. That would remain fixed. That amortization base remains fixed, and that would go down to 13 years, 12 years, 11 years, and so forth. Then any new actuarial gain or loss in a particular year. So for example, we had roughly about $100 million asset loss this year. And let's say that happened next year. That would get its own new base. That would get amortized over a 20-year period. Then whatever happens in the 24 valuation, that becomes a new base. That gets amortized over a 20-year period. If you just do those mechanics, the ultimate employer contribution rate could be below 15.32% or above 15.32%, depending upon the experience of the system. The other item that got included in the proposed funding policy was for the board to, if they wanted to, establish a minimum employer contribution rate. So that minimum employer contribution rate may be 15.32%. So even if the actuarial math going forward called for example, a 15% employer contribution rate, we would say, no, the board's established this minimum of 15.32. But if it goes the other way, if the experience is not good, for example, we have actuarial losses, either because of poor investment return or any other reason, that 15.32 could go up. It could go up to 15.6, 15.7, whatever the actuarial math would be. At that point, that would become the new employer contribution rate because we're not altering the amortization period each valuation to get back to that 15.32. We just want to make sure that the board understands that once we talk about the proposed changes to the actuarial funding plans.
Okay, I think with that, we'll move to slide 79. This is an action item that you'll be acting on today. So it's just for accounting measures. We have reserve transfers. When the assets are reported, the assets are in different accounts. We have an employer accumulation account, the retirement reserve account, the deferred annuity account. And the basic purpose of these transfers is just to set the retirement reserve account equal to the retired liabilities as of the valuation date. To set the deferred annuity account equal to the deferred or inactive member liability as of the valuation date. So in order to do that, we would need to transfer $301.6 million from the employer accumulation account to the retiree reserve account. And transfer $33.6 million to the deferred annuity account. These are just accounting appropriating the money with your accounts. It does not affect anything in your overall asset balance or any of the numbers that we calculate.
It's an internal reserve transfer calculation and administrative thing that the statutes require APERS to do. It does not affect the valuation results one iota. I think from the agenda, it doesn't appear to be an action item anymore. It's just to recognize the transfers. And so I'm not sure if you just nod your head and recognize them or.
We need to do a motion on that or just recognize the annual transfers.
I'll leave that to the executive director as to.
Has it been done in the past?
A couple of years back, we just said, just recognize it. We don't need to take motion on it.
Okay.
So
We'll recognize the transfers.
Just so I understand it better. So is this the amount that we believe will be there's not because we have a negative investment income, this is the amount of money we need to take out of our investment portfolio to pay for the benefits for our members? Is that what that is?
the answer to that is no. So we have an employer accumulation account. We have a member account. We have a retirement reserve account and a deferred annuity account. Basically, the retirement reserve account is the account for which all of the retirement benefits effectively are paid from and covers the liability associated with those individuals that are already in payment status. So if I retire this year, my money was in the employer accumulation account, and if I was a contributory member, in the member deposit account. That those monies, because I retire, now should get transferred over to the retirement reserve account. And basically, it's just shifting money from this pot over to this pot because we have new retirees. Perhaps people lived longer than we anticipated. There's investment income experience that comes into play, but we just say, okay, this is our liabilities. We need 3 point, whatever the number is, in assets in the retirement reserve account to cover those retiree liabilities. So it's to fully cover those liabilities, not just 1 year's worth of benefit payments, but all future expected benefit payments for those individuals that are already in payment status.
So is that money we can't invest?
No, that all 4 funds get invested. So the member deposit fund, the employer accumulation account, all of those funds are invested. It's just saying, okay, internally, we're recognizing that these assets are here, but they're all invested in the exact same fashion. It's just one pool of money for investment purposes. It goes back many, many, many years for public employee retirement systems. This had more to do when assets weren't really valued at market value of assets, but like book value of assets. So it's a very dated thing that public employee retirement systems are required to do, but they're still in statute, so we do it.
So how much money is in that reserve account overall?
The retirement reserve account,
Yeah,
that is a.
must be a huge number,
See if I can find.
Yeah,
like half of our money.
It would be basically our retiree and beneficiary liability. And Heidi is going to look up that number while we just go to a couple more slides, but Heidi can provide that.
Thank you.
Or if she can't. Well, she can. If we can turn to, so you'll get it.
There you go.
0.6 billion.
So 6.6 billion. Remember that Heidi had mentioned that our accrued liabilities are roughly about 12.2 billion. 6.2 billion of that 12.2 billion is for individuals that are already in payment status.
About half of our money.
What happened? Well, half of our liabilities. Because we only have about 10 billion in assets. So half of our liabilities are associated.
That was a good.
I just didn't realize. That's interesting. Thank you. Okay.
So if we can turn to slide.
At a meeting.
Eighty-one. Please. So I mentioned that back in 2005, there used to be this retirement system called the district judges retirement system. And they were folded into APERS in 2007. And district judges became a separately experience rated division within APERS. So all of the liabilities that Heidi has been talking about so far do not cover these district judges. And there's 2 divisions, or the district judges division consists of 2 plans. We call one the old plan. And that was benefits for service prior to January 1st, 2005. The new plan, which is close to new hires, is for benefits for service on or after January 1st, 2005. For the old plan, each participating employer is separately experience rated. So what we mean by that is the experience for Little Rock stays with Little Rock. So if their retirees live to 120, each and every one of them, they're going to pay for that. If, Helena If their retiree passes away, they get the credit for that. So they're separately experience rated as opposed to a cost sharing plan. So for example, APERS in total is a cost sharing plan. You know, the experience of one particular state division or one particular city or county in Arkansas doesn't affect their contribution alone. Everybody's sort of pooled together. So that's cost sharing.
It's interesting.
But when the old plan employers, and there are 30 employers still paying off their old plan unfunded accrued liability, when they pay that off, they actually become cost sharing. So they go into the what we call new plan and paid off old plan. And that then becomes a cost sharing arrangement. Similar to APERS, the contributions that we're going to be talking about are for the fiscal year beginning July 1st, 2024. For the 30 still paying old plan employers, the separately experience rated, those contributions are expressed in dollar amounts. For the new plan and paid off old plan, those contributions are expressed as a percentage of pay. We can go to slide 83. So this is a really small group. So we have 11 active members with a payroll of 1.6 million, you know, it dwarfs in comparison to our $2 billion of payroll for APERS, but you know, the district judges think they're very important, and this is something the board has to certify the contribution rates. There are 191 what we call benefit records. So those are individuals that are receiving benefits, but an individual can actually be receiving a benefit from more than one political subdivision. So even though there's 191 benefit records, there's actually 133 unique retirees or beneficiaries. Similarly, there's 82 inactive records eligible for a future benefit. So those individuals are eligible, but they're just not drawing just yet. And in addition, they could be allocated to more than one employer. And out of those 82, there's 70 unique individuals. We turn to slide 84, just talk about the liability and assets of each of these. So for the new plan and paid off old plans, their accrued liabilities are $30 million. So that's the liabilities associated with their service to date. Their funding value of assets is 26.1 million for a funded ratio of 87%. For the old plan still paying, their accrued liabilities are 7.3 million. Their funding value of assets are 2.3 million. Their funded ratio is 32%. Now their funded ratio was actually really, you know, almost zero when they first came into APERS. So even though 32% doesn't seem like a terrific number, it's progress. We're getting them towards 100% funded ratio, and we're amortizing that, I believe, over a 14-year period. So there's a mechanism in place to get them to 100% funded. And as I mentioned before, they have the option of paying off their full unfunded accrued liability. We had 2 political subdivisions do that. So as soon as they pay off their unfunded accrued liability, they become 100% funded and they get moved over into the cost sharing arrangement. The combined funded ratio is 76%. So the next slide, slide 80. Thank you, 85. So Heidi had mentioned this a little bit during the discussion of the contribution rate for APERS. There's 2 components to the employer contribution rate. One is the normal cost, and that's the cost of our active members, those I think 11 active members, accruing an additional year of service credit. In total, that's 22% of pay. The member contribution rate is 5% of pay. So the employer normal cost contribution is the difference between those 2 numbers, which is 17.06% of pay. The unfunded, the amortization of their unfunded accrued liabilities, which is for them over roughly about a 5-year period, 4.6-year period, that's 69.36% of payroll for a total contribution rate of 86% of payroll. Now that seems like a huge number, but remember, this is a declining payroll. Given their payroll, that's roughly about a $1 million employer contribution. So not peanuts by any stretch of the imagination. But as soon as I see 86% of payroll, you start to get worried but it's on a very small payroll figure. For those 30 individual old plans still paying, they're paying unique amounts that are reflect the actual experience of their system, but in total, their contributions are $582,021. And with that, I'm going to turn it back to Heidi. She's going to talk about some potential projected results for the now big, back to the big APERS system.
Excuse me,
Mr. Kern? Yes, yes, sir.
is that 86% typical of what they have been paying in previous years?
It actually goes up. The reason being is, remember that their payroll is going down. So since they're a closed group, their payroll is getting lower and lower. You know, if we have our last individual with, for example, if there's one active member left and we need a significant contribution, that UAL contribution percent could be really, really high, but that's as a percent of payroll. So, but have they been making their contributions? And the answer is yes. The fact that the contribution rate as a percentage of payroll is going up is not indicative that they're being poorly funded. It's indicative that their payroll is going down just because they're a closed group.
We'll move to slide 87. Okay, so we brought these scenarios to you back in August, and I also went over some of them very briefly. They do not reflect the new funding policy. This is just based on current policy. We're assuming different 6 scenarios of different 2023 market rates of return. And then after 2023, the assumption is that the assumed rate of return 7.15% is materialized for the remainder of the period in the projections. So if we move to slide 88, the current amortization period is 14 years. Actually about 14 and a half. It's rounded down slightly less than 14 and a half. So it's rounded down to 14 years, and that will become more important when we look at the results in the projections. There's a minimum contribution rate of 15.32% in each scenario. The projections are intended to show the near-term effect on the employer contribution rates under different phases of the gains and losses, depending on the scenario that you're looking at. And does not consider demographic gains and losses. So all of our other assumptions are assumed to materialize as we expect them to. Slide 89. Again, they're based on projections or assumptions about the future. Obviously, actual future results will determine what the actual results will look like in any given year, and may or will be different from the projections, maybe materially. And just to note that the payroll growth, if it's lower than assumed, it would generally result in a higher employer contribution rate. So if we look at slide 90, the market return for 2023 is indicated in each of the scenarios in that left column there. The middle section is our expected results as of June 30, 2026. And the reason for the 2026 is because that would be when all of the gains or losses are fully recognized. So your 2020 experience again is phased in over 4 years, and that would be fully realized by June 30, 2026. In the very right 2 columns, these are the expected valuation results for the June 30, 2023 valuation, which would determine your fiscal year 2026 employer contribution rate. So we'll start out with scenario A, assuming that all of our assumptions come out exactly as we expect. We know we have 517 million in asset losses that are going to be recognized in the next few years. So we expect our funded ratio to decrease a little bit to 82%. It's currently 84%. We expect it to go down a little bit. We move to the right 2 columns. with the current loss that's expected to be recognized in 2023. We expect that if you're using a 13.5-year amortization period, that employer contribution rate would be 15.5%. Again, that's the June 30, 2022 amortization period is like around 14.5. So we are decreasing it by 1 year every year. That's the assumption. So that gives you the 15.5. If we instead change the amortization period and increase it to 13.9 years, we can get back to the 15.32% of payroll.
And basically, the far right-hand column is what the board has been doing to maintain that 15.32% employer contribution rate.
And can I say something about that real quick, Madam Chairman? Is, the judge, the old judge, not you, the new judge. He worked hard to keep us at that. And one of the reasons is, his retirement system, we get to, that's our play. I mean, we can go, oh, okay, we need more money. The employers can pay. I mean, that really is unusual, and it's something we get to do here. And one of the things that we don't think about all the time is counties, cities, people who may be on, their budgets are really impacted, have the potential of really being impacted. And one of the reasons, for any of the new people, we wanted to keep it is, two, but we changed the date anyway. Is one, counties are on a calendar, we're on states on a fiscal. And so the judge asked us to make those determinations based on a calendar that would help people out. But also just, it's tough. It's going downhill. And so that was one of the reasons that was the discussion. And I just wanted to share that because I think it was a good decision made by the board. And I'd like to see it stay.
It served the board well. Because if the maintenance of the 15.32% employer contribution rate wasn't maintained, maintenance of it wasn't maintained, part of my redundancy there, but basically that employer contribution rate would have been less than 15.32, because remember, we dropped the amortization rate by multiple years.
Yeah.
And that meant contribution stability for all of the employers.
They could budget.
Exactly. And we got more employer contributions into the system, which is good for the funded status and things of that nature. So it has served the board well. Now, if that's still a consideration on the funding policy, then that will become some more discussion once we discuss that. But we just wanted to show what some of the potential results would be based upon what the board currently has been doing, but also to say, okay, if we do make these changes on the funding policy, there is the potential for that 15.32 to go up, because the board, at least in its funding policy, is removing that flexibility it's giving itself to, if it needed to be, if experience was poor, to increase that amortization period to maintain that 15.32% employer contribution.
Larry, do you have
Well,
a question?
I was going to echo part of what you said that, when I came here 8 years ago, our amortization period was close to 30 years.
Mm-hmm.
And our, I guess, accrued liability was, we were at maybe under 80% funded. And we made some decision over time to keep things maybe more positive, like the contribution rate that the state puts in higher than we could have lowered it from time to time, but we kept it solid at, I guess, 15.32. We've had it there for a while. And that's already programmed into our, both the state and the local counties and cities. And it just made sense not to vary that. And it's made a major improvement. I'm really, I couldn't be more pleased than where we are right now, because it's still moving in the right direction. I like it.
Gary?
And to add to that, we just Well, we just changed the employee contribution so that we're gonna increase their contribution by 2% over the next several years. So it would not look well for us to lower the employer contribution when we just increase the employee cut. Right.
Agreed.
Good attempt.
Thank you.
So
Probably that. I think we're probably done the official APERS presentation. I think the board action item that
we have an action item to affirm the employer contribution rates for fiscal year 2025. Do I have a motion?
I'll make that motion.
I have a
Second, Madam
motion.
Chair.
Mr. Walter to affirm the employer contribution rate at 15.32. And I have a second. Any discussion? Gary, do you have any comments? All in favor, say aye.
Aye.
Any opposed? And the motion carries. So we have the next action item is an updated actual funding policy statement.
This is one that we brought at the last board meeting and also talked about at the workshop. It's just updating our policy to reflect what we're doing. It was presented to the board first on February 19th of 2020, but no action was ever taken with the pandemic being at the forefront during that time. So we worked closely with GRS to update it to release what we're doing now.
So do I have any discussion on that or?
yeah, just clarify that to some extent. I think it was meant to get updated to partially reflect what the board's been doing. Meaning that, as I mentioned before, we could have lowered we have lowered the amortization period by more than 1 year to maintain the 15.32% employer contribution. We've increased it to do the same a few years back. So the 15.32, the amortization period was basically, for lack of a better way of saying it, was being solved for. The proposed funding policy is a little bit different in that the $2 billion, basically the $2 billion unfunded accrued liability, Heidi had mentioned, that's being amortized over a 14-year period. That would become fixed at $2 billion because Judge Hudson, I think, had two things. He wanted the maintenance of the 15.32% employer contribution rate. But in addition, he wanted a systematic payoff of the unfunded accrued liability. He wanted to get to 100% funded ratio. Now, whether that was universally agreed to, that's a different question, but that was an additional concept or consideration, I think, of Judge Hudson.
Yeah.
So that $2 billion, that 14-year amortization period, that would go down to 13 next year, 12 next year, and so forth. Whatever the experience is for fiscal year 2023, if it's $100 million loss, $100 million gain, whatever the question may be, that'll get amortized over a 20-year period. And so forth. That would go down to 19, 18, so forth. The next year, a new base gets established, 20 years, that'll go down 19. So we'll have a new base each and every valuation. But the initial unfunded of $2 billion is expected to get paid off over a 14-year period. The addition that got put into the proposed funding policy was that the board could establish a minimum employer contribution rate of 15.32% or whatever minimum the board wants to establish. The thought was to establish it at 15.32. I just want to make it perfectly clear to the board that if this proposed funding policy is adopted and is followed the very next year, there is a potential that the employer contribution rate could go up from 15.32%. Because if actuarial experience, if we have what we call an actuarial loss, basically let's say we have an investment loss of 200 million or so, that would get amortized over a 20-year period and basically make the employer contribution rate go up. We wouldn't alter the amortization period to stabilize the 15.32% employer contribution rate. I don't know if that is the will of the board. But that is what the proposed funding policy is currently saying. If the board wants to still basically solve for the amortization period to maintain that 15.32% employer contribution rate each and every year, I think some redrafting would still have to happen, because that's not what the proposed funding policy says. One more comment on that. Even if the board said we're going to adjust the 15.32 amortization period to maintain that 15.32% employer contribution rate, it could only go so far. So for example, I don't think we would ever suggest that the amortization period go above 30 years. So for example, but heaven forbid, 2008 doesn't happen again. There would be a loss where we say, okay, even if we extend the amortization period to 30 years, we still can't maintain at 15.32. It has to go above and beyond. So I'm not sure what the will of the board, the wish of the board is with respect to if there's comfort in the fact that the employer contribution rate could still go up because of negative actuarial experience, or is the maintenance of the 15.32% employer contribution rate sort of the overriding wish of the board, as long as we have a reasonable amortization period. And if that's the case, then I think we still have some redrafting to do. And we're comfortable either way.
Recording in progress.
I don't think so. So the
Tell me
basically
how,
you would do the math. So for example, Ms. Lee, if you look at so the amortization method. So 3B, it says beginning with the 2022 annual evaluation. Once APERS reaches a 20-year amortization period, the amortization period will remain closed and the remaining UAL will be amortized over that period. We're there now.
okay,
So we have a $2 billion unfunded accrued liability that's amortized over a 14-year period. So that's what 3B is saying. 3C is saying each year, changes in the UAL due to actuarial gains or losses, that gets amortized over a 20-year period. So for example, if next year we came in and said there's an actuarial loss of 200 million, that gets amortized over a 20-year period, which would raise the UAL contribution rate. As if we have an actuarial loss, and to raise that UAL component. Mr. Walker.
What is the advantage of doing that where you're segmenting the different years of losses to be amortized at different rates? What have we gained by doing that? Because in the past, we've dealt with it all together in one number. What's the advantage of that?
The advantage is as follows. If one of the wishes of the board is to fully amortize the unfunded accrued liability. So one of the advantages of doing that, so for example, in our $2 billion example, the amortization period right now is 14 years. So next year, 13, next year, 12, next year, 11, and so forth. You get to an amortization period that's so short that if you roll all of the unfunded accrued liability, even future unfunded accrued liability, into a really short amortization period. So for example, let's say over the next 10 years, all of our assumptions are met. So that the $2 billion is getting paid off. We have basically multiple bases of 0 over 20 years because there's been no actuarial gain or loss. We're down to a 4-year amortization period. And now we have a very big investment loss, like 2008. You would not want to amortize that over a 4-year period. That's just too short of a period to try and finance a new unfunded accrued
So
liability.
you change the period.
Well, you just say that period is 20 years. You don't change the initial.
And if you combine them, you just have to increase the period under which you would amortize the total.
And that's where we're going back
You don't
to.
want to do that.
I'm not, don't, I think that's a very reasonable policy for the board to consider. The only alternative, the only thing that, one of the reasons that it mentioned Judge Hudson's, the stability of the 15.32 was a consideration, but paying off the unfunded accrued liability was also another one. To the extent that we always, if there's negative experience and push up the amortization period, where we thought we were going to fully amortize our unfunded accrued liability over 14 years right now, that could be 26 years the very next year, which isn't necessarily a terrible thing. There are many public employee retirement systems that sort of have that sort of mindset. But you just say, okay, we're going to just take a longer period to finance that unfunded accrued liability. That's the trade-off.
But you're saying this policy doesn't allow us to go there.
That is correct.
So probably what we need to do is work on our policy a little bit more.
If the boards, and this is where good discussion is, we've been trying to be really transparent as to what the policy says. And to get the wish of the board as to, okay, you tell us what, and it sounds like the 15.32 is more of a desire than having this elaborate amortization policy and things.
As opposed to a rule.
Right.
Right.
Yeah.
Well, the rule is you're going to change the amortization period to get to 15 point, but that what the board's been doing right now. That isn't what the board, and the board adopted a funding policy back in 2014. So if you actually go back to that funding policy, we haven't been following. The board has just been saying, no, we're not going to follow that. We're going to establish this amortization period to make the 15.3. And that could be built into the proposed funding policy for the board.
Oh, well.
But that desire has been mentioned from some board members in the past, and some others say, no, we don't want to raise it, but it sounds like we're getting a little bit different direction
Harry?
right now.
Yeah, so I don't think that I think he knows more about written policies than the board members do. And for instance, and I love this guy, so don't get me wrong, but he's saying that we have a policy that says we have to lower our amortization period 1 year every year. I never knew that. And I don't agree with that. I think we need to eliminate any boundaries that are in are in a written policy right now that keep us from looking at the numbers and deciding what the employer contribution is going to be and what the amortization period is going to be. Anything that keeps us from having free reign to make that decision, we need to eliminate those boundaries or those borders in some written text somewhere. Because none of us adopted that and we don't even know about it.
And it was
So I think the 15.32 has been something we wanted to do, but I don't think we've ever said that that's ironclad, and there might not be some day when we have to change it up or down.
That's a good point.
So, and I don't think we've ever thought that we had to lower the amortization period 1 year and lock ourselves into that situation. And I don't like making the whole calculation more complicated than it already is. Creating two layers, I don't like that either. I'm just opening up here and sharing my heart.
That's fine.
Good
We
thought.
need to keep it simple and we need to give the board has that responsibility. We don't have a lot of things that we actually control here. That's one of them, is that we have to vote on this percentage once a year.
So, I want to clarify, so make sure I'm right. So the lowering of 1 year is in the proposed, not what we currently have, right?
It's actually in the one
It's
we
in the
currently
plan
have.
They have not bought.
And actually, this board didn't adopt it. I think it was adopted in 2014. But that funding policy does exist. The board can always change their policy. I think the a very good suggestion from staff is let's have a funding policy that the board's actually following. And it's always a good thing for that to happen. What the board has communicated today is the proposed funding policy isn't, there were some individuals that liked the 1 year reduction, but not being discussed today. We can come back with a funding policy
I agree.
that I believe basically incorporates the vast majority of the wishes of the board. I don't think we can always guarantee the 15.32%. We could get to an amortization period where we say, unfortunately, either we're at 30 and the employer rate's going beyond that, or we're gonna have some tough discussions about benefit changes and things of that nature again. But I don't think we want to go beyond 30 years. We could perhaps have alternate amortization periods that the board may want to consider. But I think Heidi and I have enough information based upon this discussion where we can bring that funding policy back when we do the experience study, because that's actually almost a perfect time to sort of adopt the two together. And
I think we've got a motion. We don't have a lot on this motion.
Madam Chair, do you want a motion that we table this? Do you need that?
Project. Would that be a?
Madam Chair, I would move that we table this.
Okay. I have a motion. I have a motion and a second. All in favor, say aye.
Aye.
Any opposed? Thank you very much. Yeah. Also, back to the employer contribution rate, we failed to, I need a motion for the district judges on the confirmations, on the contribution rate, and that's at 86.2%. And if I could get a motion on the district judges contribution rate.
86.42.
86.42,
I will make that motion, ma'am, at 86.42.
right. I have a motion. Do I have a second? I have a second. Mr. Wallace, all in favor, say aye.
Aye.
Any
Aye.
opposed?
Makes 15.3.
And the motion carries.
Yeah.
We'll move on. Thank you very much. And we'll move on to the administrative portion. Need a summary of the retirees for the quarter ending September 30th, 2022. Ms. Fetcher.
I will hit some highlights. This starts on page 102 on your iPad. July, we had a total of 249 retired, 82 entered the drop. And in refunds, we had 231 that terminated. In August, we had 178 retired, 24 in the drop, and 214 terminations. In September, we had 173 retired, 24 in the drop, and 243 terminated. So there's a lot of numbers there, but for the sake of time, I'm just going to hit those highlights. At the end of September, we had a total of 38,313 retirees.
And then the next item is APERS payout by county.
Right, and that's on page 108 on the iPad. And it shows you by county. I don't think you want me to read out all 75.
No, thank you very much.
Thank you.
And our next item of business is the Public Pension Standard
Oh,
Award.
yes. Just wanted to let the board know that we received this award for pension, public standards, and administration. We're doing a great job.
Awesome.
Absolutely.
Very good. Congratulations.
Next is the financial statements for the quarter ending September 30th, 2022. Jason Willett.
Look at, I guess it's page 110.
All right, thank you. And I would just like to say, this is my last meeting. I am
really?
leaving APERS and just retire. Have to leave, Gary. I'm sorry. I know you're gonna miss me. I'm leaving it in good hands and I'm very pleased because I'm going to be on the other side as a retiree. That I'm leaving it in such good hands with staff, with a new leader and with the board members. I'm gonna miss a couple of you guys a whole lot. Not everyone, but a couple of you. But thank you very much and keep up the good work.
Well, and we thank you for your service.
Here, here.
You've provided
I've enjoyed
a
it.
great deal of insight and we appreciate all the time that you
Thank you.
spent with this board. Thank you.
Appreciate it.
And wish you the best.
Can I take this?
And with that, we're adjourned. We leave.
I'll take it.
Recording stopped.